morning. It is 9 a.m. here in New York City. I'm Julie Hyman. That's Brad Smith. This is Yahoo Finance Live. Here are the three things you need to know to get off your start this morning. Results season turns to major retail reports this week. The timing is key as fresh data shows consumer confidence dropping like a stone. Home Depot kicks us off tomorrow before the bell. Watch out for that one. The stock's known for outsized moves after the numbers hit. On Wednesday, it's Target's turn, the inventory story weighing on that stock last year. We'll take a look at the role discounts and promotions are playing in 2023. And the big one, Walmart. It reports before markets open on Thursday. The nation's biggest private employer will give a definitive corporate take on the health of the consumer. Margins are a key focus here, especially the impact a rising share of groceries will have on its same-store sales. Thing number two, it's a lighter week on the data front, but April retail sales no doubt the standout for investors. The numbers come with a little more weight amid evidence inflation is starting to cool, albeit slowly. We're expecting an increase of 0.8% on the month thanks to strong spending on cars and fuel. And Fed speak is also worth keeping an eye on as the debate over June's decision heats up. Markets largely expecting a pause as things stand. The Atlanta Fed's Raphael Bostic, more and more becoming a key voice for markets, speaks at a conference today. And Cleveland's Loretta Mester, the New York Fed's John Williams, and Chicago's Austin Goolsbee all speak on Tuesday. And thing number three, the elephant in the room. We're all awaiting the debt ceiling talks between President Biden, House Speaker Kevin McCarthy, and the other principal players in the ongoing debate. It seems the sanguine tone around the issue is coming to an end, with investors keeping an eye on the so-called X date. Janet Yellen has warned it could come as soon as June 1st. Morgan Stanley's Mike Wilson has weighed into the issue, saying the impasse around raising the $31.4 trillion borrowing limit could trigger sharper swings in equity markets.
Well, retail is in the limelight this week as investors look to get a pulse on the consumer, while names such as Walmart and Target gear up for earnings. Investors are also keeping an eye on economic data out this week. Here with the details on what is in store, we have Yahoo Finance's Josh Schaefer. Yeah, what's in store in more ways than one? What's making its way out of the store? Right? Yeah.
Well, the question is, what do people buy in those stores, right? And that's what we're going to find out.
Oh, the dad jokes.
There we go. There we go. We'll get it going on a Monday with the dad jokes, right? Yes. But retail sales is really going to be kind of the first thing. We'll have Home Depot before the bell tomorrow, but then retail sales will give us a good look broadly at what's happening. And really, it's interesting when you take a look at retail sales and think about what happened last month with that surprise down 1% last month. What is expected this month is a rise of 0.8%, but mainly driven by autos. So not necessarily the companies that we're going to be looking at later this week when we talk about broad retail. It seems like the expectations right now are still relatively strong in some senses when you think about Wells Fargo coming out and saying, quote, simply, the consumer is still spending. Bank of America calling the slowdown they've seen relatively benign for now. But broader data has pointed to, especially from Bank of America also, we're starting to see a little bit of a trade down from higher income consumers. And I think that's what we're wondering if we're going to continue to see that when we talk about the companies and what we see later this week and hear from those execs.
Yeah, and so between the retail sales and the individual companies, like, what are we looking for from each?
So my three things, right? These are the three things I'm looking for this week, and we'll definitely be following and sort of putting that all into one story up there on Yahoo Finance Live for you. It's going to be trade downs from higher income consumers, inventory levels, and then what's the full year sales guidance? A company like Target has already projected, going back to last quarter, there's a chance their sales decline overall on the year. Is that still what they're looking at overall? Target also having inventory problems a year ago, told you last quarter those have been relatively fixed. How do they feel about those now? And then, of course, how that all leads into promotions, right? When we talk about retail and we talk about high inventory, a lot of times that leads to promotions, some sales. Where have people sort of been buying them? And then I think with that higher income consumer, one thing I'm really curious about in that trade down, are people still buying groceries at Walmart? I feel like that was the talk of Walmart's earnings call to some extent for me last quarter was they were getting a lot of people trading down and buying groceries there. And that grocery business really built out for Walmart. And I'm curious if that's a trend that we continue to see as well.
Yeah, I mean, it's a company on the grocery business. At least here in the U.S., they had been the lion's share leader, taking on about a quarter of 25% roughly of the overall brick and mortar grocery business. But then it's, okay, if for the pick and pack shoppers out there, where some of the new entrants have really started to chew into how Walmart is still servicing many of those households. And Walmart, you mentioned Target, Walmart had a lighter full year outlook at their last report as well here. So there's going to be a lot within even the discretionary categories to keep an eye on.
And some interesting data I was looking at too as far as foot traffic goes. Foot traffic down at Walmart, down at Target, down at BJ's in April. You're curious to see what that means when we talk about guidance, right, too, because it's important to remember we're not necessarily talking about April sales here when we talk about this week, but we're going to be talking about what's coming in the current quarter. The current quarter, there are at least less people going to the stores per some data online. So does that play out in what we're going to see moving forward, too? Because remember, while we love the earnings reports and what those numbers show us compared to estimates, we're really wondering what does it mean for the full year and what's going to happen moving forward and what's that guidance?
Yeah, I wonder if click and collect goes into those traffic numbers. I assume not, because then you don't have to necessarily go into the store.
I would guess it's walking into the store, right? So if you get pickup and they go into your trunk or however they're doing the pickup these days, it probably.
I don't get out well, I don't have a car to get out of, but I mean, I wouldn't be getting out of the car if I was getting curbside pickup.
If you can avoid it,
If you can, yeah.
Why would you?
Just keep it moving.
Thanks, Josh. Appreciate it. Looking forward to all that this week. And data on earnings so far shows healing is underway across sectors in the S&P 500. RBC Capital Markets analysis showing that as of Thursday, the pace of EPS and revenue beats for the S&P 500 companies surged past 70%. That trend extended into the small cap Russell 2000 as well. Joining us now to break down the latest earnings season and what we can look ahead to as well. Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets, is joining us now. It's great to see you, Lori. I actually have been reading your notes avidly on this theme of resilience, right? Or at least not as badness in the earnings reports. As Josh was pointing out, though, of course, especially as we look to the retailers this week, we're going to be looking at outlooks. How have the outlooks felt to you, and what are the implications for stocks?
So, I appreciate you reading, Julie. Sell-side analysts always love here that we're being read. But the reality is that whether we're talking about recent trends, outlooks, even China commentary or pricing commentary or inflation commentary, everything seems pretty balanced between companies who are saying, they're, like, if you take the recent trends or the outlooks, for example, that they're cautious or things have been starting to slip a little bit. And then on the other hand, you have a lot of companies expressing optimism. I wouldn't say they're jumping up and down excitedly, but having a more optimistic tone. And those who are saying, well, things have actually been holding up pretty well. I do notice when we look at the consumer companies, and they've been trickling in, we're obviously getting a big dose of those this week. You still see that same old story between goods and services. So the goods companies sound a little bit more pessimistic and the services companies sound a little bit more optimistic, are still talking about how consumers have plenty of money to spend, are determined to go out and travel and live their lives, sort of that kind of post-COVID, let's just get back to reality, kind of driving behavior. You're also seeing, the story of the lower end consumers are getting hit hard or hardish, while the higher end consumers are still out there determined to go out and spend. So we've been hearing about those for a lot the last, year or so. We're still continuing to hear those themes, but overall, this does not look like an economy to me that's teetering off the edge of a cliff. It does look to me like whatever we end up calling this, big recession, or recession with a big R, little r, growth scare, something kind of in between, whatever it is, it's getting started. And I think that is very, very good news for markets, because we paid for a recession back in October. Investors are really eager to start looking ahead to a recovery. I think markets are clinging to the idea that 2024 will be more of a recovery year. And so far, the commentary that we're seeing from companies, consumer companies included, is permitting that hope to stay alive.
What type of resiliency would you need to see over the summer from both end consumer or even business consumer purchasing activity in order to signal that that recovery is fully intact and healthy at the other side of it?
So that's a great question. I don't know that there's any one quantifiable stat that we're looking for. I think that there are a couple ways this could go. One, things could just end up being better than anticipated over the next few quarters, and then we kind of muddle along next year and have a more, sort of sluggish type recovery. I think markets would be fine with that. I mean, I do think that's one of the things, that idea that it will be a sluggish recovery going forward because we have sort of a shallower downturn, so to speak. That's been really powering a lot of the moving growth stocks. Growth stocks tend to perform better when sluggish economic conditions are anticipated. On the other hand, we've also been having a lot of conversations with investors about, what is some of the fallout from this regional banking crisis? What does that mean? If there's a negative impact on corporate confidence, so we see layoffs pick up, if we see lending standards, really continue to tighten a bit more aggressively than what people had already baked in, pain could get accelerated into 2023. I don't know that that's necessarily bad for the stock market. I think that the sooner we can kind of get through whatever this is, this economic challenge period, just get it started, get it over with, and allow whatever recovery is coming to really take hold in 2024. I think that's good news for stock markets as well. So I could really see it go either way, and I think they're both good outcomes for the market.
As we sort of muddle through this year and cross our fingers for next year, are there particular places, though, that you think are still going to be able to perform this year, outperform this year within the market? As you mentioned, growth, large cap tech has been strong. We're going to talk more about that with our next guest in just a few. But is that a place that still continues to perform?
So I think it depends on what you mean by tech. And I like the classic GICS tech sector, which is going to be everything from software, semis, hardware, comm equipment, kind of old economy tech. I think that in that part of the market, software, for example, there's still a lot of stuff that we can point to as having secular growth tailwinds. I also think things like semis might be a slightly different story. You saw really a bottoming out in the rate of upward revisions and earnings sentiment last year. That's still in recovery mode. It's kind of hovering around neutral revisions right now. I think there's some continuation of that recovery to come. So I feel very comfortable with that part of tech from both kind of a cyclical perspective and a secular perspective. Where I get a little more concerned, Julie, is when we talk about internet companies, and those are not sitting in the tech sector. Those are sitting more in communication services and consumer discretionary. I have had some clients, sort of raise the red flag to me saying, look, I don't think these companies are really growing as fast as they were in the past. Do they really still fit in this secular growth bucket? I think you can take either side of that issue. Obviously, some of the bigger cap companies have moats, is something our analyst talks quite a bit about. And I think he has a fair point. But I will say investors are questioning some of those secular growth tailwinds at a minimum in areas like internet. So I'm not sure if that's necessarily where I want to be in terms of playing a longer term sluggish economic backdrop. I would stick more with software companies where I'm a little bit more secure that those growth dynamics are still really there.
Lori, while we have you, debt ceiling talks are expected to resume Tuesday as the defaults deadline of June 1st looms ever closer here, particularly from a strategist perspective or even just evaluating how the markets could continue to move with that X date in mind. What most notably would you be tracking for in shifts? And if we get past that date, where might investors want to kind of steer clear of?
So it's a great question. This has obviously been the biggest issue, in my meetings the last couple of weeks. I would say non-U investors a lot more worried about it. Hedge funds a lot more worried than say domestic long-only focused investors. I do think that there's the potential for big swings in the market around this issue. If you go back and look at every debt ceiling drama since 2011, you've gotten at least a 5 to 6% hit to markets before Congress has gotten around to acting. In major drama years like 2018, 15, 16, 2011, where there was a lot of other stuff worrying investors, those hits have been more like 10 to 19%. In my mind, we're looking at something potentially like a 5 to 10% hit if Congress really doesn't pull things together soon. Now, that being said, one of the things we did over the weekend, or really late last week, we published it over the weekend, was we did look at sector performance and past debt ceiling drawdowns. And we looked at every single one since 2011, not just the big ones. And we were actually surprised to find that the value part of the market gets hit a bit harder. So sectors like financials, industrials, energy, tech gets hit not as hard as some of those other areas. So we do think this debt ceiling drama has really been weighing on the value part of the market and buoying the growth part of the market, which strangely has added to the resilience of the S&P. So I would just say this is a very, very complicated issue, but I do think it helps explain some of the woes we've seen in the value part of the market recently.
Interesting. That is interesting, the sector part of it. How long, when is all of this going to happen, I guess? Because we keep talking about the debt ceiling. It doesn't look like they're making any progress. The market has not reacted. Is it a whites of the eyes situation before we start to see stocks really selling off in more dramatic fashion to this?
I think it is, Julie. And if you talk to like the non-US investors, and I've been talking to a fair amount of those over the last month, I mean, they're much more worried than the domestic or North American-based investors who are like, look, they always get something done. And my response to the domestic investors is, yeah, sure, but they don't get it done until the stock market throws a temper tantrum. And if you look at the end of 2021, when Congress was controlled by Democrats, the White House was controlled by Democrats, and for some inexplicable reason, they still had a really hard time coming to an agreement. You saw actually markets slide about 5-ish% in real time in late September, early October, before Congress passed a short-term deal that got them through to December and allowed them to negotiate that longer-term deal that's expiring now. So even in a more recent example, where there wasn't a lot of other drama going on in markets, I mean, this still did, have a pretty big hit. I've also reminded investors that we went back again and we looked at every single one of these debt ceiling dramas since 2011. And it was not uncommon to see the stock market ignore the first or even second round of warnings. When you get closer to the X date and things do get a little bit more dire, that's when markets still tend to really, they really do tend to act up. So you do need to get closer to that damage point. And I think there was a little bit of skepticism maybe on Yellen's June 1st date. A lot of investors I've been talking to who are worried about this issue had thought July would have the X date. So I think just the fact there's some uncertainty around there, that's maybe one of the reasons why we haven't sold off too hard yet.
All right, thanks for really breaking this down for us, Lori, and hopefully we do not get to a July type of scenario here. I got too many weddings to be at that point in time. We can't have this hanging over our heads anymore. Lori Calvasina, RBC Capital Markets, head of U.S. Equity Strategy. Great to start the week off with you, Lori. Appreciate it.
Thanks for having me.
You got it. Monday morning, bringing with it a slew of political news across the globe. First, Turkey's fiercely fought election is headed for a runoff after current President Erdogan fell short of the 50% of votes needed to extend his 20-year streak. Now, the high-stakes election will ultimately decide the fate of a key NATO ally. Meanwhile, in Thailand, preliminary results show the country's pro-democracy parties secured a strong majority in the general election. If confirmed, the results would signal a resounding rejection of previous leadership, ending 9 years of pro-military rule. And finally, the G7 summit kicks off in Japan later this week. Leaders of the 7 richest nations, they're going to meet amid the war in Ukraine and rising tensions between the U.S. and China. So what does the latest across the globe mean for U.S. investors? We're digging deeper into that coming up.
It is time now, though, for today's morning brief. We're putting tech in the hot seat. Traders may want to proceed with caution despite what's been a throwback boom year for the tech trade. In the midst of what's been a fairly turbulent time in 2023, the tech-heavy Nasdaq Composite has enjoyed gains beyond that of the S&P 500 and Dow Jones Industrial Average. However, with macro risks hanging overhead, the red-hot tech trade may come tumbling down. Here to discuss, we have Technalysis Research President and Chief Analyst Bob O'Donnell hanging with us in the studio today, and he's going to be with us for a bit. So thank you so much for being here, Bob.
Thanks for having me. Looking forward to the chat. Yeah.
So we were just talking to Lori Calvasina of RBC a little bit about this idea that growth has been strong, but there are questions, and there really have been questions about that momentum. What do you think?
Well, I thought she brought up a great point to sort of distinguish between the internet companies versus the traditional tech companies, because a lot of times that stuff gets thrown together and they're very different businesses and they function in different ways. So, the fundamental thing that I'm looking at is obviously we've seen some major corrections with some of the traditional hardware guys, the semi guys, the PC companies, all those kinds of names, the network equipment company. And they're kind of shifting things around, obviously dramatic layoffs, cost-cutting measures. All of those things are pointing towards saying, hey, we know, we kind of went overboard. We need to move forward. I think, it's going to take a while, but I do feel fundamentally that you still have a lot of opportunities there, because what happened during the pandemic, let's not forget, is we all became utterly dependent on technology products and services in a way that we never did. Things we always thought were going to happen or might happen from remote work and remote school. We've been through all that now. We understand where they work, frankly, where they don't. But all of those give us an opportunity to look forward. And also some of those internet services they've become part of what we do. The way you guys were talking retail. Obviously, how much we now depend on online retail and all those things. all of that dramatically changes. And the companies who are enabling those services, it may not be that Target's doing that work, right? They're working with software companies and other services to help them with their supply chain and all those kinds of efforts. So I pull back, I look at all those things, and I think, hey, these are all fundamental opportunities for growth in the long term. And so I think there is going to be some noise in the short term. We can't deny that. And I think there's going to be another quarter or two that could be kind of tough. But if I'm looking out further ahead, I do think there's plenty of opportunities. And oh, by the way, haven't even mentioned the magic word, generative AI. And, so I know we'll get to that later. But people are going to start using technology, products and services, I think, in fundamentally different ways because of some of these advancements that we're starting to see. And again, that opens up a lot of opportunities. I think there's a lot of confusion, to be clear, on exactly where some of these things are going to go, but it's also very interesting. I've been to every tech conference I've been to over the last couple of weeks.
Yeah.
All people want to talk about, is what they're doing around AI. I was at IBM Think last week in Orlando, Intel Vision. I was up at Amazon not too long ago, Microsoft events. All these guys, they're all, grappling with and thinking about, hey, what can we do here? And I think that's going to lead itself eventually into some fundamental changes. And to be clear, I think it's different than the crypto stuff and all that, because I think that was noise.
And so as they're making a lot of major investments into either their own research and development or other areas of the business where they're hoping it will be additive to the bottom line, in this near term, for some of the pandemic darlings even, it's about what this next phase of, I think if I'm summing this up correctly based on what you were saying, normalization looks like for their business and how dramatically different they could look as a scaled entity 2-3 months and 2 years from now even.
It's a great question, Brian. Brad, excuse me.
All good.
I think that they are trying to reset things in terms of how they're thinking about this and the way the sort of projects they're going to go after, right? I mean, one of the things that happened during the pandemic where they blew up is they started doing a lot more of these long shot kinds of projects. And a lot of the things that got cut back on and a lot of the job loss, unfortunately, was around some of these longer shot things. So I think they're more focused now on sort of their fundamentals. They're determining where are the places they're the strongest, where are the closest places they can go to next, and then trying to build out from there. And, the other thing to remember is we're also in the midst of probably a decade long at least, digitization of almost everything, right? We've talked about this for a long time as an industry, but now we're really seeing it. You've got smarter versions of everything from home electronics to obviously our cars and all of these things. Those trends are going to continue. And again, we're going to see a little bit more interest there because of not only the hardware that's enabling these things and all kinds of interesting new semiconductors, but the software. And we're also seeing different companies, again, move into adjacencies that make sense. A lot of these big tech companies, for example, that were traditionally software companies, they're starting to design their own chips, right? You see Microsoft doing this. You see Google doing this. You've got Amazon doing this. There's all these companies that you don't think of kind of in those areas that are starting to participate. And then you've got lots of little specialized companies coming in from different places. I happen to be in town this week for a Lattice Semiconductor analyst event. That's a small semiconductor company that does FPGAs, very specialized types of devices, but they're used in all kinds of different places, industrial equipment, in automotive, in telco. So, and they've done very well, right, throughout all of this. So there's a lot of different places and little holes and nooks and crannies where you can find a lot of interesting tech companies, I think. And I think that's going to contribute to this bigger picture.
The question is, though, are they priced appropriately, right? And I know you're less a stock guy and more a fundamental guy, but that's really, to me, the crux of the question is normalization. It's a growth slowdown. Let's call it what it is, right? And so given the price action that we have seen, particularly this year, even where valuations sit now at a time when rates are still moving higher, or they're at least remaining at a relatively high level, that's the question investors have to ask themselves. What are they paying for right now? What are they getting for that?
It's a great question, Julie. And I, if I knew the answers to those questions, I'd be sitting somewhere else. But no, look, the reality is, I think there are some serious questions about valuations, right, that are fair to ask. It's the part of the problem, I think, is people are trying to reset their metrics, right? Like you said, what are the right metrics now? What do we think about? I mean, from everything from, do we really want to look at monthly active users for some of these big internet-based companies? Or is there some other metric that we need to be thinking about? And I think
are they making money? That's it.
Right.
Well, and yeah,
That one's coming back.
I know, exactly, I know. But you're absolutely right. I mean, are they making money? So again, I think some of this is coming back to those fundamentals. And the question is how can financial professionals figure out the best way to figure out new metrics to really measure these companies? And I think we're in the midst of that. I think people are trying to figure that out. And I think it's not entirely clear. And again, I think part of it is we've had too much of this just throw all tech in the same bucket. And as you start to pull it apart, I think you can get a little bit smarter about, hey, these kind of companies, I think, are better measured this way. These kind of companies are better measured this way, et cetera. So I think that's part of what it's going to be.
Part of the spending that you were kind of laying out amid this period of normalization, rescaling for their businesses as well, does that mean that, from your perspective, investors might have to be comfortable with an extended period of margin compression and not seeing the pre-pandemic margins that they had become accustomed to even in this near term?
It's a good question. I mean, I think there certainly is that, right? I mean, again, they've had to reshuffle their businesses and think through this. I mean, we've seen, as you said, some of the biggest tech hardware guys in particular have huge margin compression, especially on the chip side. I mean, Intel going from the 60s down to the 30s, right? I mean, it's just crazy to see that. So yeah, I think there is going to be, and it's going to be a long time, by the way, I think, before they get back to those kind of levels. So to your point, I think, investors do have to think about that. I know a lot of people don't have the appetite for the super long look aheads, but I feel like, especially in some of these things like semis, that's what it's going to take, because it's not like we're not going to need less chips. There's no question we're going to need them. But how is the business run? How do the fundamentals change? How do they start making more money? And I think some of those questions still remain. I do think there's interesting new opportunities. And again, I think we're going to see, in the case of semis in particular, more companies get into it. It's not going to be their core business, but they're going to be doing it, and that's going to help drive the whole economics around fabs and things like that.
And then on the flip side, you have companies like NVIDIA, and it now makes software too. So there's that aspect of it. All right, Bob, you're going to stick around because we're going to be discussing much more, including the promised AI discussion. Of course, we got to have one. Coming up, SoFi is sinking this morning after getting hit with a downgrade. We're going to have that and the opening bell on Wall Street and other movers for you next. are back, and we're coming up here on the opening bell on this Monday morning here. We're setting up for a higher open here on this Monday. As we talked about, the main events this week going to be retail earnings, retail sales. We've got some Fed speak as well, but really the focus is going to be on the consumer this week as we hear from heavyweights like Home Depot and Lowe's, et cetera. Let's get a check on the markets here as we open up, sponsored by Flex Shares. As we look, the futures, as I said, we're pointing to a higher open, and it looks like that is what we're going to get. The Dow just marginally higher here, just over 20 points. The S&P up by about 0.1%, as is the Nasdaq. So it's definitely not a runaway rally here by any means, as perhaps we're getting a little bit of a wait and see effect for some of those other news items that we are waiting for, Brad, like the retail earnings.
Oh, yeah. I took a photo of it, tweeted it out this morning. I'm so excited. It's going to be riveting.
About the retail earnings?
Retail earnings, yeah.
All right.
It's going to be great. Guys, let's take a look at the Dow Jones Industrial Average. As of right now, flat, just barely to the upside to start off the day's activity. Past 7 days, you're seeing us carrying some gains into the start of this new week. Nasdaq Composite, you've got the tech-heavy average. That's up over the past 7 days. This has been an outsized performer. It's up by about 2.75%, 2.8%. We'll round that off to just adding a fraction of a percent here on the day, 0.1% in the green to start things off. S&P 500, you're seeing that up by about 0.1%. Over the past 7 days, though, still looking good by about 1.7%. Let's take a look at some of the sector activity out of the gate this morning. 11 S&P 500 sectors. We've got them loaded up here for you on the touch, the Wi-Fi Interactive, and XLE, as you're seeing right now, out of the gate this morning. That's leading the pack. It's up 0.6%. Largely some fractional moves that we're seeing pretty much across the board. Pulling up the caboose, though, right now, technology, that is flat, just barely to the downside by about 0.1%. Let's take a look at some other technology players here. The mega cap tech stocks, as of right now, a little bit mixed. Taking a look at Microsoft and Google, fractional losses there, but some gains. Amazon, that's up by about 1.3%. Of course, a company that's already reported, but for the e-commerce giant, we will see how that continues to move around based on what other retailers have to say over the course of this week and what they're hearing from customers. Also zeroing in on Meta. If you've been tracking this one over the course of this year to date, it's been quite the bounce back. Last year took an L. This year they bounce back. Maybe we'll see how things continue to roll out. But year to date, it's up by about 97%. So just zeroing in on that for a hot second at the opening cross for many of our folks who might be following that one at home.
I'm sure many of them are. Brad, let's talk about some of the movers that we're watching, individual ones with news. We're talking about Shake Shack because a proxy battle could be on the horizon for the company. That's according to the Wall Street Journal. The report there says activist investor Engaged Capital is seeking 3 board seats at the chain. And according to the Journal, they've actually been in talks here for about 6 months' time. And now it's coming to this point where Engaged is sort of bringing this public, or at least linking it to the Journal so they can report on it. Essentially what you have seen here is that Engage has built up a stake of about 6.6%, including swaps, according to the Journal's reporting, and really wants to push for a stock price improvement, profitability improvement, and some other changes.
Yeah, I mean, looking for the board seats, there's 3 board seats, as you mentioned, and then also within this proxy fight, it'll be interesting to see what they're able to insert in terms of the conversation to get to the profitability metrics that they're looking for. They're looking for them to double their profitability within 2 years here. And so that is particularly noteworthy. Of course, Shake Shack has already reported earnings for the quarter. That came out last week, and the company had reported revenue that was actually up by about 24.5% versus the same period last year. You also saw system-wide sales move higher by about 27.5%. So largely a question of where, even in the interactions, the engagements that they have with their end consumers, where they're able to promote more profitability that investors can perhaps bank on in this near term. But it's also going to come at a spending period for them too. If they're continuing to open up even more stores, they continue to give an update on the number of locations that they're going to have to roll out in order to create more customer touch points and hopefully drive some of the profitability along the way.
Yeah, and Shake Shack did come back to us with a statement on this, saying we're executing our strategic plan and making substantial operational and financial progress. And they cited some of the figures that you were just talking about from their most recent report. Importantly, I think, in this discussion of profitability, Shake Shack pointing out that for the year, they are predicting that consistency in adjusted EBITDA that it will be a record year for that figure. Restaurant level margins, they say, should return to 19 to 20%. I think that one of the issues here, if you look, I was looking back at the EBITDA numbers on an annual basis, and there's a consistency issue, in part because of the pandemic, but even before that, a consistency in the level of profitability, a consistency in the level of those margins that I imagine Engaged wants them to improve upon. I was also taking a look at the stock performance. As they pointed out, the stock is up more than 50% year to date. Right. It's also down about 50% from its high, which was back in February of 2021, when so many stocks were flying and then have come down. The IPO, though, all the way back in 2015 now. I remember that IPO. It was very exciting. Yeah. At $21 a share. So they're obviously, we're not talking about a company that has languished since its IPO. It's just maybe not as robust, perhaps, as a shareholder like Engaged would like it to be.
Yeah, I mean, and you mentioned the Shack sales. They're looking to get that back to 19 to 20%. Right now, most recent quarter, 18.3% profitability. So yeah, getting there. Still a business that had to report an operating loss in this most recent quarter, about $3.2 million. So will be interesting to see if we see any improvement on that front for Shake Shack. But the Chicken Shack is tasty. I'll say that.
Yeah, definitely. A lot of it's tasty. All right, let's get to the big merger that we are hearing about in the gold space today. Newmont Mining has secured a $19.2 billion deal to acquire its Australian rival, Newcrest Mining. That deal is pending regulatory approval, but it does mark the largest deal ever in the gold mining sector. This is something that's been talked about now for a little bit here. It was public that Newmont was pursuing Newcrest here, and the initial proposal was made back on February 5th. So this is about a 30% premium at this deal price to where it was trading right before that deal was first proposed. In addition to beefing up the gold mining capability for Newmont, this also increases its exposure to copper. Newmont's, the real bulk of its revenue does come from gold, about in the 80 to 90% range. Whereas Newcrest also is very reliant on gold, but has a little bit more of a copper operation too.
Yeah, and within kind of the need or the push for more copper, you think about the areas within even the Inflation Reduction Act that had carved out space for electric vehicles to really get even more of a credit, or not just credits, but even more of the build out and where copper comes into play for so many of those batteries as well. But then also you think about the prices that we had seen of gold. Gold is still, if I remember correctly, hovering or near the ballpark of some of those record highs too. So all of this taking place as you're taking a look at gold futures right now, sitting above $2,000 at this point.
Wow, yeah.
We're also watching shares of SoFi today. This has been interesting to track this morning. It's down 9%. This is after Wedbush downgraded the stock from neutral to underperform, slashed their price target from $5 to $2.50, saying SoFi's fair value accounting may present headwinds here. They also noted that there were no loan sales in 1Q, the first quarter, raising questions given that SoFi designates its loans as held for sale. And then they also mentioned that an equity capital raise is apparently being contemplated here. That would lead to a dilution of the share value as well.
Yeah, this is a really interesting look at, and wonky look, let's be honest, at SoFi's accounting. But if you are lending out money and then you sell that loan book, you get a value in the market. It's valued in the market. You know how much it's worth. If you're not selling that loan book, then you're just guessing internally at what that loan book is worth. And that is what this note is kind of focusing on. And interesting here, the analyst behind this, I want to mention, who's doing this underperform downgrade, is David Chiavarini, who we spoke to about regional banks. So he's been tracking the whole regional bank crisis really closely. And it's interesting that he's now turning his attention to SoFi. To be frank, I didn't even know he covered SoFi, right? Because it's usually covered under people who look at fintech. So it's interesting that he's the regional bank guy, and he is looking at this issue of how these loan books are valued. It reminds me, I have to say, of the so-called held to maturity, right? Or hopefully held to maturity, unrealized losses. So in other words, we're still talking about the idea of unrealized losses or unrealized valuation. How do you value something internally? So this is kind of I'm not drawing direct parallels, but I'm just, my brain is just thinking along those lines.
Maybe it falls under Shivarini's coverage because they did receive regulatory approval to operate as a bank as well.
Yes,
so
it must, yes.
Perhaps they're in, and a fresh face for David to be watching right now in comparison to the rest of the regional banks.
Unluckily for SoFi today.
There you go. Yeah. And all eyes are on OpenAI this week as well. The OpenAI CEO, Sam Altman, prepares to testify before Congress for the first time tomorrow. Bob O'Donnell, Tech Analysis Research President and Chief Analyst, is back with us. And you've been watching this one closely. What are the kind of top takeaways that you would be looking for or expecting to hear from this testimony?
Well, I mean, the big questions that are out there are around things like safety, security, and frankly, there's copyright concerns, right? I mean, the way these things work, at least certainly the way the OpenAI models work, is essentially they sucked in all the data off the internet, and then processed through it to create their algorithms. Well, in the process of doing that, obviously, they sucked in things that were theoretically copyrighted. And so the question is, how can you tell what's going to come out of this? Now, this is not unique to them, by the way. Everybody who's doing this, if they bring in all that content, is going to have these issues. But I think the other big concerns are, right, there are people now, who are going through these Terminator, kind of visions, like, oh my God, this stuff is going to take over the world and what have you. People who don't really understand what's actually going on. And of course, we had that letter from, all kinds of people saying, oh, this is a big concern. We need to step back. Mind you, some of that was by people who are a little behind, who need to catch up, but that's a separate point. But I think fundamentally, there are big questions like what's going to happen? How do we control this? There are obviously potentially concerns with foreign nation influence. All of those factors come into play, right? Because if we start to have these algorithms feed us information in a way that we don't expect, that's, is legitimately, obviously, a very big concern. So I think there's going to be a lot of questions like, hey, tell us how this works. Help us explain what you're doing so we can understand this as the leader. Remember, though, that, again, there are plenty of other companies who are doing very similar work. Google just had their I/O event where they talked about their answers to that's being done. And by the way, Google actually originated most of this research that now is being leveraged by OpenAI. Microsoft, as I said, is doing the same. We're seeing all of these big companies do this. But I think fundamentally around this, the questions I think are going to have to be around those types of issues around security, around safety, and things like that.
It feels like, as usual, Europe is way out ahead of us on regulation of this, right? Like, why is it so? I mean, they're a diverse collection of all these different countries, and we can't even get it together. Very simple things like, if you are interacting with AI or looking at an AI-generated image,
it needs to be
has to tell you that it is. Like, how simple is that? Why not just enact something like that? Or, I mean, and I don't know that this is federal legislation, but like, anecdotally, how many people have told you that they've been writing term papers using ChatGPT? It is rampant right now, at least on an anecdotal basis. Like, there's just really, you don't need to understand how AI works to know
that's an issue.
What should be and what should not be on a certain level, right?
No, you're absolutely right, Julie. And the issue is you're starting to see companies do this, right? I mean, Google at I/O said, we are going to do watermarking, essentially, notifying the ways in which we do this. Adobe has talked about that because Adobe is doing image generation work. Mm-hmm. So they're doing that. There are companies who've been out there before this really exploded looking at some of the watermarking types of technologies. So I think you're right. We have to do this. Europe has already gotten way ahead of us on this. They did that with privacy as well. They just are much more sensitive to those things, and they're just being much more conscientious about it. We're still, cowboy, wild, wild west kind of a country in a lot of ways. And, it gets reflected in these kinds of motions or lack thereof. So I think you're right. I think there are some very obvious things that need to be done and need to be quantified. And then people have to figure it out. I mean, there's so many questions out there around this technology. I happen to be doing a survey myself right now as part of my work of what companies are going to use generative AI for, and if they're going to use it, why and how. And it's still too early to say for sure. But
it's not everybody on everything?
Yeah, no, not quite yet. But
that's what it feels like
I know.
now.
And I think a lot of people are seeing that. It really is interesting to, again, I just have some of the early beginnings. I'd be happy to come back and share with you when I have it all done, because I think it'll be great. But I think that people are toying with everything from, gosh, do we actually replace bodies now? Or is this something we can do later? There was the comments from IBM CEO about a week and a half ago about how they're not going to fill existing empty roles because they think eventually AI can do that. So you got a lot of people who are scared about this. But let's remember, every technology transition that has ever happened in the history of the world has caused people to lose certain jobs and move on to other jobs. That isn't necessarily a death knell. It's evolution of how society and economies work. Right. And so I think a lot of people get caught up with the scary side of things, and all these horrific stories of everything taking over the world. There is immense power and capability in what some of this stuff can do. But of course, to quote Spider-Man, with great power becomes great responsibility. So they do have to figure it out. And so back to your original question, I think there's going to be a lot of questions like, what can we do? What can we allow? What do we need to tell people about? And then how do we think about this? And it's going to take a while for people to, kind of really let it soak in, like, gosh, what can this do? And how can we leverage it? I think what's different about this, I kind of made a joke earlier, versus, say, crypto and some of the other buzzy things we've seen happen, is that we've probably all tried it ourselves, right? We didn't necessarily, maybe you all guys all did a bunch of crypto. I didn't, my kids did, but it wasn't necessarily something that you could immediately see. Like the first time you try some of these things, you're like, oh, wow. Yeah. And you recognize the potential opportunity that you can have. And I just did a piece for USA Today that just came out last Friday, and explaining, to the mainstream folks about, hey, you have to write emails, you search the internet all the time. This is going to change the way you do those kinds of basic things in a fundamental way. And in fact, you're going to go back, a year from now and think, gosh, the way I used to do that was archaic. It's really old.
Time intensive, for sure.
Yeah. Now, to your question about ChatGPT generated term papers, yeah, there's a lot of things that have to get figured out, right? There are issues that have to be dealt with. And people have to get smarter about the way they do it. I will tell you an interesting little story I read once, speaking of that in education. One professor, rather than ignore things like ChatGPT, he said, I want my students to really learn it. So what they did is they initially said, basically have it generate a paper on XYZ topic. But they were all relatively generic and obviously fairly similar. But he taught them that this idea of a prompt. So if you've used any of these conversations, you have to be smart about what you type in to the prompt. And there's now prompt engineers, and there's this whole technology development happening around doing smarter prompts. And the gist of the story is, by learning how to write better prompts, it generated significantly better output. So the trick was learning how to write the prompts, not necessarily even the output. And it was a very clever way of thinking about this. And I think, again, we're just at the tip of this stuff.
Just to kind of put a bow on the event with Congress today. Congress is typically, or when it does happen on, is it today or Tuesday? Tuesday.
Yeah.
Everything's running together.
Yeah.
On Tuesday, when this event takes place, and you have a Congress that has typically been behind the 8 ball in trying to understand new technology, whether that's the blockchain, whether that's metaverse, whether it's social media, they typically just ask questions about how do you make money? Or how are users protected? What is the number one question that they could ask to Sam Altman about generative AI that would at least set the tone or signal to the broader American public and consumer that, okay, Congress might actually get this or be on a pathway to understanding?
Ooh, that's a good question. I think they would have to ask about limits and controls. How far can it actually go? And so that they sort of a boundary. Because right now I think there's this sense that there's literally no boundaries around this. And so I think if they can understand where the boundaries are, and what's keeping it sort of within reins. I think that would be a starting point. And then understanding, again, where the information is coming from, what information is being used, dealing with trust issues. I mean, Lord knows, unfortunately, we've gotten to this point in the world where it's very difficult to know what you can and can't trust. And this, unfortunately, in some ways, is definitely going to make it worse, right? So you have to be aware of that. And so we have to learn to understand what we can do. And part of it is just, transparency, really. It's a lot of times with this stuff, it is about being transparent about what the technology can and can't do, right? It's just as important to know what it can't do as what it can do. And then knowing that and explaining that in a way that people can understand, and then kind of learning, all right, now how can we, use this for good, and what are the opportunities? In the meantime, you're going to have a whole bunch of people who are super smart on the cybersecurity side and everything else, figuring out, hey, we got to be a step ahead of the bad guys because they're going to use it too. So how do we prevent that? And that's going to be an ongoing challenge for a while.
Bob, thanks so much for hanging out with us this morning.
Thanks. Enjoyed it.
Absolutely. Bob O'Donnell, Technalysis Research President and Chief Analyst. Appreciate the time.
Yep.
Absolutely. And coming up on the other side of this short break, everyone, if there's one thing investors don't like, it's uncertainty, especially when it comes to emerging markets. Turkey looks like it's facing an election runoff. So what could that mean for the lira? We're across the pond and the latest moves in the next block.
A slew of political news across the globe on this Monday morning. Let's start in Turkey, which is heading for a runoff vote in an election that could end over 2 decades of power for the current president, Recep Erdogan. Preliminary results showing the incumbent with a lead of more than 2 million, but that is not enough to avoid a second round. That's scheduled for May 28th. Meanwhile, in Thailand, the country's pro-democracy parties gained a victory in the parliamentary vote. It's a big challenge to the royalist-backed establishment that's been in power since the military seized power in a coup almost a decade ago. And finally, the G7 summit kicks off in Japan later this week with the U.S. and its allies expected to put more pressure on China. The Wall Street Journal reporting the countries will issue a joint statement rejecting the use of an economic retaliation against nations over policy disputes and other disagreements. So, a lot going on. How should investors play the global picture? How should they be viewing the prospects for global growth? Let's bring in Brendan McKenna. He's Wells Fargo international economist. So obviously a lot to piece through here with these different events going on. I guess we can start with the G7 first because that's probably has the biggest global impact here. What are you expecting, particularly as regards policy with China, and then how the sort of read through to global growth?
Yeah, I think the message from the G7 meeting is going to be pretty consistent from what we've seen over the last couple of years, in the sense that there's going to be this coordinated approach to kind of contain China from an economic perspective, also maybe from a geopolitical perspective as well. And I think that, again, that's been a pretty consistent message, at least since the Biden administration took over a few years ago. And we've also seen some pretty consistent messaging from the rest of the G7 on that front as well. So I would expect some type of communique or some type of message that, again, just reinforces that point of containing China, again, from an economic and a geopolitical standpoint.
Where do you think there might be overlap in the talks among all of these countries with regard to their own interest rate policy that they've enacted separately and in some cases in kind of tandem in order to combat inflation in their respective nations?
Yeah, I think maybe a theme will be that inflation is a problem. Tight monetary policy is something that needs to persist for the time being. But I think when you're thinking about monetary policy from each of these central banks, again, maybe they're coordinated, but they're not necessarily saying we're going to raise interest rates in tandem with you. We're going to conduct our own independent review of monetary policy and inflation, and we'll adjust interest rates accordingly. As domestic economic conditions evolve. So there may be a theme there, and there may be some coordination, but I don't think each central bank is assessing monetary policy in tandem with other central banks.
Well, and then there's one that's been an outlier for a little while, and that's the Turkish Central Bank, right, which has sort of adopted a very unorthodox policy under President Erdogan, really his influence of cutting rates to combat inflation, which is unlike pretty much every other central bank around the world. As you look at the Turkish situation, is there now potentially a road to reversing that? Or I don't know how much you guys are gaming out the political chances of him to survive this runoff vote.
So we're certainly gaming out the chances of Erdogan surviving the vote. And I would say after the first round, there's probably a higher percentage chance that Erdogan actually retains office. And some of these unorthodox monetary policies that you mentioned, those are probably going to be in place for the longer term. So if you're thinking about a reversal or a reversion back to orthodox monetary theory in Turkey, I don't think that's something that's imminent, and I don't think that's something that's going to be a result of the presidential and parliamentary elections that we're going through right now.
Do you see any kind of improvement in the economic situation overall in Turkey?
Unfortunately, no. I think if you have a policy direction that's led by unorthodox monetary theory, that unfortunately leads to currency crisis, above target inflation, in some cases hyperinflation, and all of that just has negative compounding economic effects going forward. So I think this kind of muddle through situation with, again, economic deterioration that Turkey has been going through for years now is something that's likely to persist, assuming that Erdogan retains office and kind of leads the direction on overarching monetary and economic policy in Turkey.
And then switching on over to some of the other emerging markets we're watching, there was the Thai election as well. There's also Argentina trying to bolster its currency. So as investors are looking at the sort of idiosyncratic individual situations around the world, where are you seeing potentially most opportunity for economic growth upside?
As far as economic growth upside, I think a lot of the upside is probably going to be captured in Asia. We've seen China reopen. We have some pretty encouraging Q1 data. Some of the economic rebound may be starting to mature, but I think you're still looking at a scenario where China grows 6% this year. And that's a relatively strong growth rate. On the same side, I think India is also an economy that's probably positioned for economic growth upside as well. So you might be looking at an Indian economy that grows somewhere in the 6% range as well. That's a growth rate that hasn't been achieved in India for some years now. So I think when you're thinking about the majority of where global growth is going to come from, it's going to come from China, India, Indonesia, and most of emerging in Southeast Asia.
And is the emerging in Southeast Asia and Indonesia, is that also because of the relationship with China, or are there other nations that people should think about as well that are really intertwined with that market?
I think the China reopening is certainly playing into the economic upside across the region, but I think there are some other idiosyncratic stories that are, somewhat positive for some of these emerging Asian economies. In India, we had multiple shocks starting with COVID, the war in Ukraine pushing up commodity prices. It looks like all of those effects are going to ease going forward. Then we also just have some other success stories in EM Asia, like Vietnam, Taiwan, Thailand, where these countries have become more integrated into the global supply chain, and we're slowly starting to see the benefits of those developments now. So I think those are somewhat idiosyncratic and country-specific developments that, again, can lead to positive upward surprises on the economic growth front.
Thanks a lot, Brendan. We don't talk a lot about international economies, but it's important for U.S. investors to know there's other places that they can put their money, not just in the U.S. Brendan McKenna, Wells Fargo international economist. Thank you so much. Appreciate it.
Of course. Thank you for having me.
A quick check on the tax preparation services. TurboTax and H&R Block, those shares are following sharply this morning. Of course, Intuit, the maker of TurboTax, and we'll tell you why next. Tax season may be over, but our trending tickers today are tax related. Intuit and H&R Block, Intuit the parent of TurboTax, they're falling this morning after reports that the Biden administration is now considering creating a government-run alternative to the two companies. Democrats have been pushing for the IRS to offer free online tax filing on their website, claiming these services should be free for middle-income Americans. The IRS is expected to release a report this week on a possible direct file system, and the Biden administration will then decide whether indeed to pursue it.
Coming up, retail earnings are on tap this week, but our next guest is warning of 3 key considerations for investors to keep in mind. We'll discuss that next.
Welcome back to Yahoo Finance Live. I'm Julie Hyman along with Brad Smith. We're not seeing the markets do a heck of a lot today in terms of overall index level price action. That's as investors are waiting for results from retailers this week, as well as the overall government retail sales numbers. So I'm taking a look at some individual movers here. We talked about SoFi Technologies a little bit earlier after that downgrade to underperform. And the shares down about 2% year to date. Today, they're off by about 10%. We also have a big deal in the pipeline industry, $18.8 million in cash and stock. That's how much ONEOK is paying for Magellan Midstream Partners. You're looking at ONEOK for the year to date. It's down about 7% today. Magellan, as you might expect, is up about 15% in today's session. So 2 big resource deals today. The gold one that we talked about earlier, Newmont acquiring Newcrest of Australia, and then this one in pipelines as well. And then some of these are sort of feed-throughs from Friday. First Solar, for example, which saw a big boost on Friday, is coming down a little bit today by about 2.5%. Elsewhere today, in what we are watching on some of the heat maps that I'm looking at, you know I keep looking at these regional banks to see how they're doing day by day, and I don't see any red on this screen. That's the first time in a little while that we have seen that is the case. PacWest, for example, that's one of those stocks we've been watching very, very closely. Right now is up 6.5%. As I mentioned, retail earnings are on deck this week. Target, Walmart, Home Depot, they are all set to report. Our next guest says with cautious consumers and depleting savings, top-line pressure should be expected. Dia Ear, who's S&P Global Ratings Retail Director, is joining us now. Thanks for being here. So as we look ahead to these results, is that the sort of theme we should keep in mind, that basically don't expect much?
Yeah, hi, good morning. Thank you for having me. Yes, I think that, 2022 obviously was a very challenging year for a lot of these big box names, but we're not expecting a much better 2023 in the sense, even though you're lapping that tough 22, that was sort of supply chain driven, it was cost driven, that was the profit pressure. Now we're seeing that stabilize, but we're seeing a different set of challenges. We're seeing top line pressure because of the consumer, because of inflation and all the various demands that they now have on their own wallets.
How would you classify this consumer? Banks have said that it's a healthy consumer. We've heard resilient used as well. How would you say that the consumer is engaging with some of the largest retail brands that we're waiting to hear from this week?
Yeah, I think part of that, comes from that big savings bump that they received in the pandemic, and it's taken a long time to deplete that. So even through 22, that was in place. I think we are seeing more pressure this year, though, for a variety of reasons. Unemployment showing cracks, inflation persisting, discretionary demand not what it was even a year ago, and bigger expenses around gas, around food, even for the high-end customer. A new trend we're seeing is that customer really trading down in a meaningful way. So you could start to see why Walmart probably will do pretty well this week, even Costco. But, I think luxury was an area we thought really could sustain, but even that consumer is coming down pretty quickly this year.
Now, I know you're a credit analyst, so you're looking at that side of the equation as well. And I am curious, in this kind of rate environment that is also a tough consumer environment, are we going to see more retailers raising more capital? Or how are we going to see them sort of trying to attack some of their maybe capital shortfalls in this environment?
Right. Great question. So, good news, a lot of them stockpiled a lot of cash over the past few years. That brought leverage metrics down. Debt loads were not very high. So again, they've come into this challenging time fairly well equipped to handle that from the numbers that we look at, which are credit metrics. But in terms of where capital comes from next, it's really store closures, unfortunately, maintaining capital spending at lower levels as they bring store counts down. You're seeing that in malls for a long time, but now you're also seeing that off mall. You've seen everyone from the superstores to the drugstores to specialty names, home, so many of them closing stores to maintain that capital. So I think that is a trend that will continue, especially as we also note shrink levels, shortage levels, inventory challenged in urban areas. So companies are really trying to look carefully at their overall footprints.
We already got results from Amazon weeks ago. Did what they say on e-commerce set up what the reality or the common denominator could be for a lot of the other major retail players?
Yeah, I think so. That obviously was an area that gained share for a lot of these names, but even for a Costco, for instance, they sort of can't offset the lower foot traffic with online as much as I think we had expected. I think Target might see some pressure there too. In some ways, this will be an easier year because they're lapping such a difficult 22. There should be just more upside. But I would completely agree what Amazon said is consistent with what we're expecting for retailers this week.
Furthermore, on a retail bellwether, of course, the behemoth that is set to report, Walmart, if Walmart comes out and says that this fiscal, or rather full year, is going to be a down or a compressed year in comparisons to years prior, what does that kind of set up for more broadly the rest of the markets? How might that also trade on just what Walmart has to say?
Yeah, definitely an important bellwether we're all watching this week. We actually expect them to have a pretty decent quarter, and guidance shouldn't surprise to the downside the way it really did a year ago for these big box names. So, mid-single digit revenue is sort of the expectation relative to maybe a low single digit for a Target. And a lot of that, again, trade down for grocery in particular has been a real win. Walmart has also been streamlining their brands, really evaluating their portfolio in areas like apparel. bringing some of that more in-house and rethinking some of the big acquisitions they had done over the years. So I think in all of those ways, plus the supply chain, there is a view that hopefully the situation has stabilized from a year ago. You already started to see that over Christmas. So I think in terms of guidance for profitability, it should at least kind of bring them back closer to pre-pandemic levels, which has been our base case going forward.
Well, we will see if any of them believe that generative AI can solve some of the near-term problems as well. Dia Iyer, who is the S&P Global Ratings Retail Director, great to have you here with us this morning. Thanks for previewing and teeing up the retail earnings season here.
No problem. Thanks for having me. Have a good day.
You too. Let's take a look at one trending ticker we're watching this Monday morning. Shares of Monday.com are surging after the company said it now expects to report an adjusted operating profit for the year of $8 to $12 million after previously saying it expected a loss of $32 to $36 million. The company's CFO said the new target is 2 years ahead of our prior expectations. Shares up 11% this morning. And coming up, the impact of a debt default on investors and how the banking crisis could make it all worse. That's next.
Let's do a quick check of the market sponsored by Flex Shares. And we are seeing stocks take a little bit of a leg down here, but still not a huge change on the day, with the Dow off 0.4%, the S&P off 0.3%, and the Nasdaq losing just about a tenth of 1%, excuse me. As we see, stocks sort of muddle along here. We've got oil prices that are trading a little bit higher today, bond prices that are relatively steady, a little bit of a leg up to around 3.5% on the 10-year. So all across the board, seeing some sort of muted movement, Brad. Yes. And the debt ceiling deadline is looming. The Treasury Department has warned the government could run out of money to pay its bills as soon as June 1st. President Biden is reportedly planning to meet with top congressional leaders Tuesday after discussions set for last week were postponed. The U.S. has never defaulted on its debts, and doing so would have an alarming impact on the U.S. economy. That seems to be something that everybody agrees on. Moody's Analytics estimates that stock prices would fall by almost a fifth and would wipe out $10 trillion in household wealth in the event of an actual default. For more on this, we turn to Jillian Tett, the Financial Times editorial board chair and editor-at-large of the U.S. Jillian, thank you so much for being here. There are a lot of dire warnings out here, and yet, as we talked about earlier in the show with a market strategist, markets don't tend to react until late in the game, and then they sort of force the government's hand. Is that what's going to need to happen once again this time?
Yeah, it's very frustrating indeed, because history shows that the only thing that can break through political gridlock and get Congress to back unpopular decisions is basically a markets crisis, a full-blown markets crisis. We saw that in 2008 with the financial crisis and the so-called TARP measures. So I suspect it probably will take a full-blown markets crisis to actually bring the Republicans and Democrats to come together to do what is the obvious solution, which is to raise the debt ceiling, but to create some kind of fiscal commission to look at the longer-term fiscal health of America. There's going to have to be compromises around tax rises, around spending cuts of some sort. You can't get to any kind of fiscal health or sustainability without some difficult decisions. But unfortunately, getting the kind of appetite for compromise is going to be very hard without a crisis. And that's the last thing that investors or the Federal Reserve want to see.
What type of impact could this net out for investors? I mean, if we were to see that, if we were to see not just moving past the X date, but then having even more of the, I've said rigmarole in the past in Congress, but the theater that's taking place in Washington, D.C., that gets to this point where parties are just blame shifting, and at the end of the day, nothing is actually getting solved.
Well, what we should say first up front is that Biden's come out in the last few minutes with a statement saying that he's actually quite optimistic about the meeting tomorrow that's happening between himself and the Republican leaders.
That's good.
The fact that the meeting was cancelled on Friday has given some hope to the markets that actually there are serious discussions going on between the staffers. So maybe, never say never, maybe something will come out tomorrow that actually proves what I'm saying to be wrong. But one of the things that's been very unhelpful has been the fact that the former president, Donald Trump, came out last week in the CNN town hall and essentially said to the Republicans, go ahead and let the US default if there aren't radical spending cuts. And what that means is that for Kevin McCarthy, Speaker, it's going to be that much harder to try and corral people like Marjorie Taylor Greene away from their very radical positions and get a deal done. Now, if there is no deal done, if we do go towards default, there's three things that can happen other than default. The Treasury could essentially use a gimmick like issuing a $1 trillion coin it sells to the Fed to avoid default. It could simply use some of the constitutional powers it have and just ignore the debt limit, or it could also prioritize payments to make sure it keeps paying the interest on the bonds but stops other payments. So there are other options available to Janet Yellen, and many people in the Democrats right now are saying that they should be used. But they're all of quite questionable legal standing. Janet Yellen herself has indicated she doesn't want to use them. And so if we do get towards that X date, I think you're going to see quite a sell-off in the markets and quite a rise in borrowing costs. And that's definitely going to hit investors of all stripes, not to mention mortgage borrowers.
Jillian, I have sort of a bigger picture philosophical question, I guess, about the national debt. Why is it a problem? In other words, like the U.S., in any practical terms, it doesn't matter how much the U.S. borrows, right? Unless at some distant point in the future, it loses credibility in international markets. That's happened in other countries' cases, right? Certainly in some European countries. But is that a realistic threat at any point in the next hundreds of years? I don't know.
Well, there's two ways that the debt is a problem. The first is that essentially the interest payments on debt are going up dramatically right now because of the rising interest rates. I mean, during the last, period since 2008, the interest rate payments on debt were incredibly low. In fact, remained low and stable, even though the amount of deficit actually tripled or debt tripled overall. And that was because essentially the lower the interest rates, the smaller the interest payments. What's happening now is that as the rates rise, interest payments, the debt servicing costs are exploding to a point where they're eating up a significant chunk of the budget and essentially displacing other items on the budget that the government would like to pay for. So that's one problem. The second problem, and by the way, that problem's serious unless you believe that interest rates are going to go crashing back down again to almost zero. And it's very hard to make that case right now. The other problem, of course, is that if at some point the people who are buying debt stop buying it because they fear that they could be a default, then you end up with a very nasty scenario and essentially a self-reinforcing vicious cycle. At the moment, there isn't much sign of that. But what you have to remember are two things. Firstly, a very big buyer of debt in the last 10 years has been the Federal Reserve. And of course, that's going to be ending if the Fed is serious about embarking on quantitative tightening instead of quantitative easing. And secondly, the behavior of foreign investors right now is quite uncertain. What you've seen recently is that Chinese purchases of US Treasury bonds has fallen quite steadily. Japanese purchases have been fairly stable, but they could fall also going forward. And groups like the Middle East have been buying lots of treasuries, but somewhere like Saudi Arabia is starting to embark on a massive domestic investment plan, which means that the petrodollars may not be recycled to quite the same degree going forward. So it's entirely possible to imagine a world where the demand for US treasuries begins to taper off. And if the US keeps issuing more and more treasuries to basically increase the debt, you could again see rising market interest rates, more pressure, more questions about sustainability, and that would create problems too. And last but not least, there's also the issue that high government debts often crowd out private investment, and that's bad for innovation and dynamism.
Gillian Tett, Financial Times editor-at-large. Gillian, always a pleasure to get the thorough analysis and insight here, especially as these are very much moving conversations and parts, even as you had brought up the Biden administration's latest announcement this morning here. We're going to be watching closely for where the football gets moved forward here a little bit. Thanks so much, Gillian.
Take a sweepstake. I'm not too optimistic. We'll see. Thank you.
Thanks so much. Guys, coming up, from a plucky punk magazine to one of the most highly valued private companies in the world, in the United States. Now it's heading for Chapter 11 bankruptcy. What happened to Vice Media? We're going to take a look into the steep downfall next. Vice Media has filed for Chapter 11 bankruptcy. The news coming early Monday morning and represents the latest defeat for the digital media space following the closure of BuzzFeed News last month. For more on this, we turn to Yahoo Finance's Alexandra Canal. Ali, what do we know about this one?
Well, Brad, we know it's truly a fall from grace since Vice Media was once looked at as the crown jewel of the digital media sector. The company had seen notable investments in its heyday from A&E Networks, 21st Century Fox, and even Disney, which invested a reported $400 million in Vice back in 2015. Flash forward 2 years later in 2017, Vice was valued at $5.7 billion. But then late last year, the Wall Street Journal reported the company was seeking a valuation of just $1.5 million. So a huge downtick in that valuation number, on top of the company not being able to meet its revenue targets in the past year. In an attempt to help manage costs, Vice reduced its hiring, laid off workers, and restructured the business. But those efforts were not enough to offset rising debt, rising expenses, on top of that sky-high valuation that burdened a lot of those sales options. So the writing was really on the wall that a bankruptcy filing was coming. As part of this, Fortress Investment Group, Vice's largest secured creditor, along with a consortium of lenders, will invest around $225 million as a credit bid. The lenders have also secured a $20 million loan to help Vice continue operations in the interim. But as you mentioned, this comes amid that continued upheaval in the media sector. BuzzFeed shut down its news division as part of wider company layoffs late last month, while Insider confirmed it would be laying off 10% of its workforce amid, quote, the same economic headwinds as others in our industry. So just this media reckoning, if you will, especially among those early and really dominant players in the digital space.
Ali, speaking of media and changes afoot there, Luminar Technologies, friend of the show, CEO Austin Russell, he's buying a majority stake in Forbes. Now, he is a car tech company, as we know. Like, this sort of came out of a little bit of left field, right?
A little out of left field. There seems to be a lot of confusion on why he'd want to do this. Of course, we know that we've seen this from Elon Musk, Jack Dorsey, these big time executives dabbling in multiple companies. But Austin Russell, he's a 28-year-old billionaire. He's going to purchase that 82% stake in Forbes. That's going to value Forbes at $800 million. Now, Russell's stake includes the remaining portion of the company that was owned by the Forbes family, while the seller, Hong Kong-based investment group Whale Media, will have minority ownership. Now, Whale Media has been attempting to sell Forbes for years, so this deal finally ending that drawn-out process. And really, we knew a sale was coming for Forbes as well, especially after it called off its SPAC merger in June of last year. The SPAC market has just completely dried up and left a lot of those companies seeking a deal with very limited options. Now, in a statement, Russell said, quote, Forbes is something I had always looked up to as a brand and as a media empire. He doesn't plan to get involved in the day-to-day operations of the business, but he does plan to set the vision for the company and lead Forbes into its next phase of growth. So again, just another weird sign of what's going on in this industry, a lot of significant changes, and I wouldn't be surprised to see more media M&A to come over the next year and over the next several years as this industry continues to change and develop.
Ali, thanks. You'll keep us up to date, I'm quite sure. Thank you. Speaking of another deal, Fanatics has agreed to buy sports betting company PointsBet's U.S. business for about $150 million. The company's announcing the news in a joint statement on Sunday night, and they're writing, quote, while there are still several steps in the process to complete the acquisition, both parties are confident in the outcome. Fanatics is going to gain access to at least 15 states that PointsBet currently operates in, expanding its reach. Shareholders will vote on the deal in late June. Of course, Fanatics is a privately held company. Michael Rubin heads up that. PointsBet trades in Australia.
Yeah, look, I enjoy this deal, and especially kind of looking at, I enjoy this deal, yes. Blanket statement, and I'm sticking to it. Taking a look at the DraftKings stock, though, here today, and some of the other gaming companies that already have their own infrastructure, their own play, kind of going after the sports betting community that has seen much more of the license component come online, much more of the retail and kind of brick and mortar sports books Fanatics, for the same right, has also done so. I believe in Maryland is where we saw the first one come online recently this year. And so taking a look at DraftKings stock here separately, you're seeing that kind of move lower on this news. That's down by about 0.5%. Penn Gaming or Penn Entertainment still holding pretty solid right now. It's just about, well, flat. I guess it could have moved lower. But then Caesars and MGM, interesting there. And I zero in on those because of what we had already seen from Fanatics starting to get into some of those brick and mortar capacities. Now, of course, a lot of other components go into an MGM Resorts or a Caesars Entertainment and the different parts of their business that they operate outside of just the sports gaming or the sports book. But I think for PointsBet and for Fanatics has been able to not only generate these partnerships with pretty much every major sports league and association for merchandise and official retailing. They've gotten into memorabilia, now getting into betting as well. I think it's just the next natural step for them. And it was January 20th that they had officially opened their retail location in Maryland.
Yeah, this is something that they've been looking at, that Michael Rubin's been looking at for a little while here and figuring out how to get into this market. I mean, DraftKings and FanDuel really dominate the online sports betting market as it is in the U.S., and there is a lot of competition between them, right? That said, PointsBet has 95 million customers in the U.S., so that's what Fanatics is gaining through this deal. It's interesting, there was an interesting note out from Bloomberg Intelligence that said the valuation of this PointsBet U.S. sportsbook at 1.7 times 2022 sales, they say that implies a valuation about half that of DraftKings enterprise value to consensus sales, and which in other words is a discount.
Yeah.
And so what does that imply about how competitive this market is, how much value these various operations have? Maybe raises some questions going forward, but it doesn't seem to be raising enough questions to drive those stocks down in today's trading. So maybe they're not immediate questions, maybe they're sort of longer term questions, existential questions.
The competitive landscape is getting more competitive.
Yes, that's the summary. Yes. Coming up, airlines have faced a bumpy ride over the last few months. Our next guest says one major challenge is still ahead. We'll speak to the former CEO of United Airlines about that and his new memoir next. Airlines have been facing some turbulence over the last few months as they grapple with cancellation backlash and impending strikes. Our next guest says airlines still have one big challenge to overcome. It has to do with air traffic control. Oscar Munoz, former United Airlines CEO and author of Turnaround Time, a new memoir. He's joining us now alongside Yahoo Finance executive editor Brian Sozzi. Oscar, it's such a pleasure, first of all, to have you in the studio with us. We've talked to you recently about some of your newer ventures remotely, so thank you for coming in.
Thanks for having me.
I want to get to your memoir, but I want to talk about air traffic control first, because we have talked a lot about the summer travel season and some of the challenges that airlines have faced. Talk to us about the role that air traffic control has played in what's been going on.
Well, it becomes an increasingly part of your air travel experience because for safety reasons, that's important, we're still safe, we have to slow everything down, air traffic control systems. The way they communicate from ground to the earth is outdated, and there are much more modern systems out there that are deployed in many countries around the world, and we just haven't made the investment in this country. It's part of the broader infrastructure issue for sure, but it's something that has to get on the radar screen, and it's complex, and it's going to take a long time and a lot of money. Probably has to be a private venture versus a federally funded one, just because of the cycles of funding that happens in the US government. And you have to attract the best and brightest. So it is complex, but that would go a long way towards a lot of the ills and ails. And again, I know the government wants to regulate a lot of those things and punish the airlines. And again, when we need it, we're happy to take the brunt of it, but a lot of it is not necessarily, it's mostly out of our control with regards to air traffic control.
Well, now we have potential spending cuts as part of any debt ceiling debate here. How debilitating would that be to the air traffic control?
That's exactly my point. Let's say we had a really involved process and everybody was engaged, and then you have a situation like this. In the first place, people are going to cut. Well, many projects, but this would be one. And so I think that's one of the reasons why it's been so complicated to do that. And privatization may not necessarily be the case, but I think it's the most realistic and practical way to do this, because it's going to take years to get this done.
Airlines right now have been trying to chart their own turnaround from the lows or the lulls of the pandemic and how it shut down operations essentially. Yeah. And so now with what we've seen over the past 2 years and even furthermore, how some of the very issues that we were discussing on the kind of infrastructural side need to be amended or at least solved for in order for companies like Southwest Airlines, who are continuing this broader airline comeback, to get past some of their own operational issues. What does that turnaround look like for companies on top of the turnaround that had already been taking place post-pandemic?
Well, unfortunately, part of leadership and involving large companies, especially that service the consumer, you have to think ahead. And I think one of the things that United did well over the course of that lull, right, we lost 93% of our revenue, is to think ahead and invest. So we kept investing in our aircraft to keep them maintained, and we were able to use a lot of money to train our folks to be ready. But nevertheless, it is a double issue, and with demand coming as hard, people want to travel. It's amazing how people are, as you've seen, and so it is going to be a tricky posture, and some airlines will fare better than others, and deferred investments that, and obviously, are going to come back, and I think the airline you mentioned was clearly one of those situations.
Oscar, you're definitely not retired. You sit on a number of boards, recently Salesforce as well. What's the biggest challenge leaders are up against at this moment?
I think the economic climate, right? I mean, everything you hear is about economic uncertainty. The debt ceiling is the current issue. You got the work from home. You have a shortage of. I mean, it's always tumultuous, but it's particularly tumultuous, and it's hard to see ahead of the corner. So I think the most important thing, at least in the boards that I follow and the senior managers and CEOs that I work with, it's from board perspective, we just try to keep looking ahead. What is it that you do best? Let's keep doing that well. Let's discuss it, and let's get the organization lined up behind it, and then tell investors in a very transparent way what's ahead. And cycles are cycles. We've all lived through something. This cycle will end, and you have to be ready for the top end of it. So but the tough thing is staying focused when you have all this noise around you.
Speaking of cycles, you've experienced some cycles of your own, so to speak, as well. You write in your book about your heart attack followed by a heart transplant. And, that's a situation where your body is telling you have to slow down. You do not have a choice. How is that fed through to leadership? And I think about it because especially right now when leaders are managing millennials, for example, and now Gen Z coming up, who have a different approach to work, how has that kind of informed how you think about all of that?
Resilience is a wonderful term, meeting turbulence, all of those things we talk about in a trite way. When you face a life-altering, potentially life-ending situation, you really do get to appreciate what's wonderful in this world. And for me, going back to work was an easy conversation because of the outpouring of support I had from my united family. But yeah, work is work. And, you talk to anybody that's accomplished anything in life, when they go back to those early days, I'm sure all of you in this room, there's a portion of your life and career where you just have to work hard and do work that maybe isn't what you want to do eventually, but you'll get there if you put in the effort.
Does this next generation, just building on what Julie asked, do they have it?
You know what, I have children of this age, and I know many people, and I stay very close to this, and there's a lot of apps out there that give you a lot of insight. Yes, they have it. You just have to find the right mechanism in communication, listen and learn from them before you lead them. Because we all read these headlines, well, Gen Zs are this and millennials are that, and it's like they're not all that. It's like you have a conversation with your people in your environment, create your own culture, and I think you'll learn a lot about how to apply it for you and your company, not what everybody is. You can't label people. I think if you ask many of them, I think they hate being labeled. It's like we don't like being labeled, and so why is it okay for do that? So yeah, they have the stuff. They just need to learn. And if you look over history, the original Gen X, right? Where are they now? Well, they have mortgages and children and family. Right? We're not working for a living, so it'll all evolve.
Even within that, we talk so much about hustle culture or grind culture all the time, which is essentially just a nice way to say workaholic in some cases. But do you think that's pivoting now with new technologies such as generative AI even, or the different tools that we can leverage as a resource to drive a more efficient culture, if you will, among employees, among the workforce more broadly? So
a lot of questions in there. So I always say, everyone wants to work for a good living. Increasingly, we also want to live a good life. And the definition of good life has changed given COVID, because we got to experience things. People stay home with their kids and all of that. So good life has been defined. So you have to understand with that regard. New technology is wonderful as long as it doesn't make you lazy, right? I mean, it's like you just can't dial it in and say, hey, Chad, put this presentation together. And again, we worry about that aspect of that. I was just at an event that somebody said something I think wonderful. There's fake gold because there's the real gold, while there's artificial intelligence because there's real human intelligence. And I think that's a really important part for us to remember. We are not going anywhere, and our brain capacity shouldn't go, and we shouldn't allow it to go easily into that good night of using other people to do our stuff for us. So it'll be a combination.
Oscar, you're writing in the book about your upbringing. I believe you and your mom came over from Mexico or immigrated here to the United States. Just curious on where you're at, where your emotions, your head is at as we gear up potentially another contentious election in this country.
This will sound like I'm running for office or something, but I can say this from experience and the thing we were able to solve at United. You have to have two sides of a conversation that want to move forward and do the right thing. Increasingly, in a lot of our social issues, it's like yes and no, or red and blue, and they're such polar opposites. There's no one yearning for a solution that brings us not only together but forward. And I think with regards to immigration, it's a very it's heated on both sides. And I think if somebody were just really somebody or a group of people I know it's complex, but if you just started with the concept, let's solve this. For the practical reality that it's required, we need workers in America. How do we manage that process? And if we started there, I think we would have more progress. But now, all immigrants are bad, and you should let everybody in the world in. It's just two polar opposites. So I've always been able to bridge gaps between two, chasms in some cases, and I just don't think we have that civil discourse anymore. We just go to our respective sides and really, really push hard, and nothing gets done, and we sit here trying to resolve this issue time and time again.
Are you running for office, Oscar?
Yeah, no.
Let us know if you do.
Oscar Munoz, who is the former United Airlines CEO, alongside Yahoo Finance's executive editor, Brian Southey. Thanks so much for taking the time.
Thank you all for having me. I appreciate it. Thanks.
And coming up, the days of haggling may be behind us. Tesla's price shifts are shaking up the car buying process, but what does that mean for buyers looking to get the best deal? We're getting under the hood, or the front, next. Let's do a quick check of the market, sponsored here by Flex Shares. Taking a look at the Dow, the S&P 500, and the Nasdaq. We're seeing some mixed activity. The Dow right now is flat, just barely to the downside here. We've seen that hit both positive and negative territory on the day. The S&P 500, you're seeing that flat, just barely to the upside there. It's been an interesting one to track out of the gate this morning. We're just shy of 90 minutes into today's trading action. The Nasdaq, though, holding on to gains right now by about 0.1%. Last week, Tesla ticked up the prices for 3 of its models in the U.S. The latest in a slew of price fluctuations so far this year. The EV maker's floating price strategy is unique among car companies. Typically, manufacturers set the price, or the MSRP, once a year. Customers can then do like I do. They haggle at the dealership. So the final price tag may be lower or higher than what the manufacturer originally set. But Tesla doesn't sell through a dealership. Instead, you buy a new car directly from the company. Pricing and price fluctuation, it's more transparent because there's no negotiating. So what does this shakeup in strategy mean for consumers? Joining us now, we've got Greg McGlure, who is the Auto Blog Editor-in-Chief. Greg, good to have you here with us this morning. So kind of comparing and contrasting how Tesla has gone about this in their storefront strategy versus the typical manufacturer-dealer relationship. How does this kind of set the price pathway forward for a company like Tesla that has investors that still want to see it net a margin at the end of the day?
You know, it's really interesting. Thanks for having me, by the way. Car pricing has really been in the spotlight in the last few years for a variety of reasons. You know, the chip shortage, inflation, COVID, and they've all made it more challenging than ever to buy a car. Both new and used car prices are impacted. And, you know, with Tesla, Tesla being Tesla, it's been perhaps most amplified, most in the spotlight. I think Tesla specifically can be more responsive to market demands, and they're more willing to raise or lower prices. Obviously, this always gets a lot of publicity because Tesla is Tesla. But, you know, what's interesting is price hikes are actually not totally uncommon. Ford has raised prices on the F-150 Lightning, the Bronco, and other vehicles multiple times this year in response to supply chain shortages and some of the demand issues that I just laid out. So it's not totally uncommon across the industry. But in the case of Tesla, just to stop, the car buying process is very streamlined. Just sort of before this interview, I was literally almost buying a Tesla online. You see the price, you can click, you basically add it to your cart, and away you go. So when that, bottom line number changes, obviously Tesla buyers are going to get pretty fired up.
Greg, it's Julie here. I mean, obviously you've covered the car industry for a while and much more closely than we have. Was there all pre-Tesla? Did we know when the big car companies changed prices, or was that something that was just sort of between them and the dealers?
So not so much. I think, again, the last few years with the pandemic and supply chain, that's really amplified the issue simply because people can't get the car they want, or it costs more than, they're used to paying. So that's been a really big challenge for consumers and also the industry. Dealers, OEMs are all very concerned about it. I would actually go even farther back to almost like the early days of the internet, when car sites started publishing, the invoice price and the MSRP, and you can see the difference because the invoice price is what the dealer pays for the car. So, consumers, myself included, would print out what you think the car should cost and go in and just start arguing. Not everybody likes doing that. Ordering something online is a little more, it's easier, it's less confrontational. But to me, that's when this whole sort of like Pandora's box was opened, because consumers have greater visibility now than they ever have had before, as far as just knowing what they think their car should cost.
Some potential buyers fill up their Saturday morning coffee just getting ready to go haggle, Greg. So now, when we think about what's come forward in terms of even credits for electric vehicles, how does that change the negotiation structure or fabric for some of the dealers right now who are still going to be trying to move through, say, the F-Lightning or any of the electrified GM vehicles, these legacy automakers who have their own inventory to move through?
So for me, it's just another sort of bargaining chip, another card to play. That, hey, you might get up to $7,500 off, which is great. That. So that's a little bit of a buffer as a consumer. That being said, I think, the move is you just walk in and keep haggling, trying to get as low of a price, even start below the invoice price, and then see maybe where you can land. The tricky part, too, is, does the dealer have that car you're looking for? Does it have the trim model, the color, all those different elements? And that also kind of can sort of maybe tip the scales back in favor of the dealer, because at the end of the day, they could always just say, hey, well, we have the red Mustang. Do you want it or not? Here's the price. So it's always a bit of a give and take, that's for sure.
Yeah, unless you're walking into a Tesla dealership, I guess, because then there's not much wiggle room. Greg, unless they're raising or cutting the prices like they're doing every week now. Greg Migliore, good to see you, Autoblog editor-in-chief. Appreciate it.
Thank you.
It's official. Microsoft's Activision Blizzard acquisition has been approved by EU regulators. The green light is a big win for the company, coming just weeks after UK watchdogs blocked the deal. Shares of Activision and Microsoft, they are both rising on the news. The European Commission saying commitments made by Microsoft in the cloud gaming sphere staved off antitrust concerns. That said, we don't know what U.S. regulators are going to say. So we got the UK saying no. We got the EU saying yes. Usually the U.S. follows their lead, but their leads are different. So I don't know what's going to happen now.
Right. And for Microsoft, for Activision Blizzard, what they have had to continuously prove is that there will not be a material kind of detriment that is incurred by consumers because of the very popular titles that Activision Blizzard has, if those were to be brought in to Microsoft that already has its own dominance in the console category, in cloud as well, and how it's kind of weaving those together. And then now you have the titles that would be produced by Activision Blizzard coming all under the same roof. Yeah, so it looks like the UK watchdog did not find Microsoft's reassurances credible. The EU did. TBD what happens here in the US and whether the deal gets done. Rochelle Akufo has you for the next hour of trading. She's got much more for you. Stick with us.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. The next leg, results season, turns to major retail reports this week. Home Depot, Target and Walmart all on the docket. We'll ask our strategist if strong numbers could help stocks break out of a very tight range. And shaken or stirred, an activist investor sets its laser beam on that most high-end of food chains, but has it bitten off more than it can chew with Shake Shack? We look at a growing proxy fight in the food space next. And the AI debate heads to Capitol Hill. The CEO of ChatGPT maker OpenAI testifies to Congress for the first time tomorrow. What kind of an audience can he expect? We'll look ahead to that coming up next. But first, let's check in on the major indices. We're seeing they're still searching for some direction here, relatively flat. You see the Dow, they're just barely in negative territory, down about 20 points. The S&P 500, they're also down just fractionally there, down about a point. Nasdaq, the only one seeing some green shoots there, but ever so slightly, up 13 points on the day so far. Let's also take a look at what we're seeing with the Treasury market as we wait the resumption of those debt ceiling talks that are coming up on Tuesday. You see the 5-year up ever so slightly, though, about 0.5%, the 10-year up more than 1%, and the longer-term 30-year yields up about 1.5%. All right, well, investors are keeping a close eye on China's economic data this week as it provides insights on the momentum of its recovery. Month-to-month changes will be a key focus, especially for companies that have enjoyed a lift from China's economic improvements. With more on the influence of the Chinese consumer for U.S. companies, we have Yahoo Finance's Ines Ferre joining us. Hey, Ines.
Hey, Rochelle, that's right. And investors will be paying close attention to that data that you just mentioned, especially when it comes to retail sales, especially when it comes to sales related to services. Because remember that the Chinese lockdowns were pretty severe. So now that they have been lifted, companies have been talking about what they've seen with the consumer spending more on dining out, the consumer spending more when it comes to traveling as well. And we've already seen some companies that have been benefiting from the China recovery. And some of these include the ones that you see there on your screen, like Starbucks, Disney, Procter & Gamble, Marriott. So taking a look at Starbucks, for example, its fiscal second quarter, a big turning point for the company, surprising the street with China sales up 3%. The street had expected for those to be lower. Starbucks has been on an expansion plan when it comes to China, increasing its footprint in China. And during their last earnings calls, management talked about the decision to keep opening stores during the pandemic, despite disruptions. That decision is paying off. Moving on to Disney. Disney's international parks have been a bright spot for the company, with Shanghai Disney Resort, that's seeing improvement, with management talking in their last earnings calls about higher attendance and improved financial results when it comes to Shanghai. Also looking at MGM. MGM's results blew it out of the park when it comes to MGM China, where their net revenue increased 130% from the prior quarter. The end of the lockdowns definitely very positive for the company. MGM is up 26% year to date, Rochelle.
All right, great stuff there. Keeping an eye on some of those impacts there. Ines Ferre there for us. Thanks so much. Right, well, while markets have seen some gains year to date, despite a turbulent year thus far, consumers are feeling less optimistic amid economic uncertainty. Here with more on the rift between Wall Street versus Main Street, we have Rebecca Felton, Riverfront Investment Group Senior Market Strategist. Thank you for joining me this morning. So I first want to start with earnings season. The expectations did seem to be relatively low going in, but then when you look at what we're seeing between this consumer sentiment most recently for May versus sort of off to the races in year to date, especially for big tech, what are we missing here in the Wall Street to Main Street story?
Well, thank you so much for having me. And it really is a very stark difference when you think about how the company management tones were as we navigated through Q1 earnings reporting period. And then you look at some of these sentiment numbers that we got last week. The University of Michigan preliminary numbers were very disappointing. And their consumer inflation expectations over the longer term ticked up higher too. So clearly they're feeling the pinch across the board in terms of their prices that they're paying. We will be watching those retail numbers that you spoke about earlier in the segment this week. We have a lot of consumer-facing data, and that's really going to give us an indication as to what happens when we think about overall GDP, consumption trends, and that sort of thing.
And it does seem to be that at least some parts, especially big tech, really jumping ahead to beyond a pause, which we still haven't actually had yet from the Fed, to then a pivot at a certain point. But then how do you allocate your portfolio in this sort of environment when we still don't even have the pause yet, but you're watching markets sort of off to the races?
Well, and when we look at our portfolios in general, we are fairly neutral across the board because, to your point, there are so many unanswered questions. Inside of that U.S. equity space, we actually have a full allocation to technology. We're sort of neutral, maybe slightly over, but we're playing that space primarily in the mega cap tech area. We like the consistency of earnings, the consistency of revenue, almost the subscription-like aspect to the cloud. So we would prefer to be there because they do tend to have the ability to weather bumpy economic situations a little better. If you think about it from a barbell standpoint, we've also started adding back some energy and some industrials and that sort of thing.
And as I'm looking at some of the sectors that you like, you mentioned energy there, also mining, healthcare, as well as the mega caps there. We know that energy's been under pressure so far this year. What is the criteria that you're looking at when you're picking out these sectors?
Well, again, what we're looking for, in addition to consistency and improving momentum in earnings growth, we're watching yields and the ability of companies not just to pay those yields, but to grow them. We have an acronym here. We call it PATI, pay attention to the yield. So that's been a very important component as well.
And when you look at where valuations are at the moment, and then you look at how some of the recession signals are flashing, what does that mean then? How do you sort of take all that information and decide which part to follow?
Well, we are of the mind that if we do have a recession, and of course, as you mentioned, the indicators have been deteriorating since the beginning of the year. Those leading economic indicator numbers that came out recently were a huge disappointment. But we believe that if we have a recession, it will be probably late in this year or more likely early 2024, and it will be mild. And of course, some of the data that we're looking at, the employment levels, again, corporate earnings growth resuming perhaps in the back half of this year. There's a lot to be positive about when we think about the growth dynamic of the country, but it is probably going to be a bumpy ride. And we think we're going to be stuck in a trading range here from about 3,800 to 4,200 for quite some time.
So then when you balance that with some of the stickier parts of inflation, the labor market, housing, wages, of course, still a focus for the Fed as well, how do you invest for a pause versus a pivot?
Well, going back to those sectors, inside of equity, we are still overweight U.S. We recognize that international markets are cheaper, but we haven't seen a recovery in those economies such as we have here, and certainly the earnings growth characteristics are a little behind us. We've also added back to our fixed income exposures. If you had talked to me a few months ago, we were underweight. Now we're getting closer to neutral as those yields are going over 4%, and we find them more attractive. We are playing it from the standpoint of how it's allocated, shorter end of the curve, inside of 5. And then if we look at the longer part of it, it's about 20 years in terms of our exposures. But again, so many unanswered questions. We think neutral is the best place to be right now.
I do appreciate you joining us with your insights. Rebecca Felton, Riverfront Investment Group Senior Market Strategist. Thank you so much. All right, taking a look at shares of SoFi falling today after Wedbush downgraded the stock from neutral to underperform. You see there it's now off about 8.8% there, also slashing its price target from $5 to $2.50, saying SoFi's fair value accounting may present headwinds. Another concern, SoFi's need to raise additional capital to support growth. The stock has been trading downwards since the beginning of the year. Now, this is Wedbush analyst David Chiavarini's second downgrade on the stock in 2 weeks, so people are paying attention. The street's slightly mixed on SoFi with 9 buy consensus ratings, 7 holds, and 1 sell. All right, coming up, shaken or stirred? An activist investor sets its laser beam on that most high end of fast food chains, but has it bitten off more than it can chew with Shake Shack? We look at a growing proxy fight in the food space next. Let's do a quick check of the markets, sponsored by Flex Shares. Still looking at a mixed picture here, although the Dow now the only one in negative territory at the moment, down just slightly, about 5 points. Could turn any second now. The S&P in positive territory, just barely there, up about 1 point. And the Nasdaq up 28 points, or 0.25%, seeing some glimmer of a hope, though, as we watch for those debt ceiling deadline talks that are coming up. All right, activist investor Engaged Capital is gunning to start a proxy fight for 3 board seats at Shake Shack. Engaged currently has a 6.6% stake in the restaurant chain, which has seen its shares cut in half because of inflation pressures and a slowdown in lunchtime traffic. Joining us now is our own Brooke DePalma to discuss this more. So, Brooke, break this down for us.
Good morning, Rochelle. Well, shares this morning of Shake Shack rising after Wall Street got wind of this activist investor. Now, as you noted, Engaged Capital plans to start a proxy fight with the now global hamburger chain Shake Shack. And as you noted, they have a nearly approximately 6.6% stake in Shake Shack, including swaps. And here they are seeking 3 seats on the board. Now, the activist investor reportedly sent a letter to Shake Shack's board back in March outlining a proposal for new directors. They also asked for changes to help boost shares of Shake Shack, including asking Shake Shack to retain a consulting firm to help improve operating efficiency and make changes to its super voting share structure. In addition to that, they're also asking here, Engaged Capital, they're saying that they have ways to double Shake Shack's profitability within 2 years. And taking a closer look, as you could see, shares now are far lower than the highs that they were back in 2021, where we saw shares more than $130 per share. But in a statement from Shake Shack to Yahoo Finance, the company said, quote, "We are executing our strategic plan and making substantial operational and financial progress. We are guiding full year 2023 to be a record year with expectations to return restaurant level margins to 19 to 20%. Now, in addition to that, Engaged Capital did not return our request for comment, but this is not the first time that the street has seen Engaged Capital do something like this. Back in 2015, it pushed Jamba Juice's parent company to slash costs, and from there, Engaged Capital founder Glenn Wellings gained a seat on the board. In addition to that, back in 2014, it played a role in a board shakeup over at Abercrombie, with the settlement announced after 1 month. And so this might just be the beginning of a potential fight here.
So with that in mind, I mean, right now, Shake Shack is positioning itself for massive growth. So break down how that's all going to work.
Right. Well, this is something that we spoke about many times on Yahoo Finance. Shake Shack's global plans to really become a leader in burger chain across the globe. Right now, they operate more than 460 locations globally, including about 300 here in the U.S. In addition to that, they plan to open nearly 40 in the U.S. and 30 to 35 license operations this fiscal year. In addition to that, they're also investing heavily in drive-through. They said that they have planned to open about 15 drive-throughs this year. But keep in mind, Rochelle, that something that the street is watching is the cost to build these new locations as well as drive-through. On the call, we heard that this year's new locations built will cost more than last year on average. And in addition to that, as you noted earlier, we're seeing a change up in terms of consumer behavior here. Urban locations for Shake Shack prior to the pandemic saw a lot of volume, but now with workers perhaps not coming in daily Monday through Friday, they're seeing perhaps less volumes on Mondays and Fridays. And so lots to watch here when it comes to Shake Shack.
Well, appreciate you getting us up to speed on that. Brooke DePalma there for us. Thanks so much. Well, store closures, bankruptcies, and plummeting consumer sentiment have hit staple American retailers over the past year. Let's paint a picture of the damage so far. Just a few weeks ago, Bed Bath & Beyond stripped down its big blue signs and announced the closure of 400 stores across the country. During this time, Walmart made headlines by closing several stores in Chicago, while Nordstrom shuttered its stores in San Francisco. The closures coming amid a flurry of bankruptcy announcements, including Party City and David's Bridal. So what does the picture actually look like now for commercial real estate? We're joined by James Cook, JLL America's Director of Research for Retail, to discuss this more. Thank you for joining us this morning. So people are always talking about sort of the death of commercial real estate, especially in light of what happened with the banking crisis and some of these tighter lending conditions. Give us the truth here. What is actually happening with commercial real estate?
Oh my gosh, there's such a negative sentiment out there. And the truth, I track the data, is actually quite different. We are seeing historic low vacancies in commercial real estate, in retail real estate right now. And what happened is after the last Great Recession, developers stopped building much new retail real estate. So basically, new retail construction fell off a cliff around 2009, and we've had steady demand by occupiers wanting to lease more retail space and a limited supply. So to this point now, we're at the lowest vacancy that we've ever seen historically. I mean, there's just not much out there. And you talk to the occupiers that are expanding right now, especially you were talking about Shake Shack, folks that are looking for good drive-through locations. It is really slim pickings out there.
So then, as you mentioned there, we didn't see a lot of the sort of new retail construction since the great financial crisis, and then enter Bed Bath & Beyond here to really shake this up. So, I mean, assuming that the auction of these locations is approved by the bankruptcy court, what does this mean then for pricing in the commercial real estate space?
I don't think it's going to affect pricing. If we're talking about pricing from an investor perspective, I don't think it's going to affect pricing that much, honestly, because the Bed Bath & Beyond spaces, those are ripe for releasing by new tenants. There's multiple tenants out there that are looking for that space. Bed Bath & Beyond was mostly in open air, what we'd call, power center or, community centers, which are places that, especially since the pandemic, these daily needs shopping centers are the exact kind of places that everybody wants, all retailers want to lease space at right now. So the demand is really there. And Bed Bath, going out of business, it's more of an anomaly than a representation of what's going on for retail tenants right now.
Because especially when you look at some of the growth plans for like a TJ Maxx, Dollar General, they're growing their expansion plans. And when you keep in mind the size of some of these Bed Bath & Beyond locations, I mean, some of them range from 18,000 square feet to 92,000 for Bed Bath & Beyond, and between 14,000 and 63,000 for the Bye Bye Baby one. So in terms of who's really primed to take advantage of this, are there certain retailers better positioned right now?
Absolutely. So the categories that are expanding right now include value retailers like, Burlington, Ross Dress for Less, TJX, Marshalls, those kind of retailers. They're perfect to release that Bed Bath & Beyond space. So not to mention, there's a bunch of like regional players that are expanding as well. There's definitely going to be demand.
And in terms of what this does to the sort of the tenant mix when it comes to these spaces, I mean, I've heard everything from, new office space to pickleball courts going up there. But what are your expectations as to how this grows from here and what they do with these spaces?
Okay, so it is true that there are some pickleball courts that are going into, say, a former big box location. But for the most part, the vast majority of releasing for this vacant retail, I don't think it's going to be as fun and funky as I would hope. That's what I would want to see. But again, it's a lot of, the folks that are expanding right now. It's value retail, so it might be, like I mentioned, a TJ Maxx. It also could be value grocery, so an Aldi or a grocery outlet. And then, of course, the other big category that's expanding is quick service restaurant, the fast food. They're still expanding.
And so then how do you sort of play that with what we've seen with that consumer sentiment survey that came out, and really there's also this rising consumer debt that we're seeing as well, hitting some record levels. As people sort of pour into these leases while looking at some of these consumer trends, where do you think the next level of growth is going to be coming from, especially as we have some of these, still seeing these recession signals flashing?
Yeah, well, now is a time for retailers who have a value proposition to really do well. So, your super centers, your Targets, your Walmarts, places like that. Any folks that seem to offer some kind of value. So that's where that fast food comes into play, because that can be an inexpensive way, an alternative to doing maybe more an expensive meal on a Friday night, do a family takeout at home or something like that. So, recessions are always, sorry to use the R word there, but headwinds in the economy and negative consumer sentiment are always great times for value retailers to kind of grow some market share from consumers that are trading down, especially middle-class consumers that are saying, you know what, this weekend, we're not going to go to the fancy department store. We're just going to go down the street to the super center.
And so then when you also look at consumer spending on services, how does that play into your outlook here?
Oh, yeah, that's a great point. So the other big consumer trend that we're seeing right now is, so going back a few years, the pandemic, people just stopped buying, services because, you were just stuck at home, and everybody was buying TVs and, all these home goods and, all the things to improve their home. Now that trend is reversing itself, and people are spending money on experiences again, and not as much on electronics and home items and things like that. So this is actually an opportunity for another trend that I'm really deep into researching right now, which is the ticketed experiences. And so that could be like indoor mini golf from Puttery and Putt Shack. We've got dart concepts. My team identified over 9 million square feet of new entertainment concepts that are going to be expanding within the next 1 to 2 years. So there's obviously an expectation that the trend of spending money on experience is going to be growing in spite of the headwinds of the economy.
I love that. I've been seeing a lot of these sort of indoor golf / restaurants as well. They're always jam-packed. So clearly there's something there to keep an eye on.
Yeah.
A big thank you there to James Cook, JLL America's Director of Research for Retail. Thank you for joining me this morning.
Thank you.
All right, coming up, a Tennessee-based airbag manufacturer has been told to recall 67 million inflators. Its response is putting regulators and automakers in a tricky spot. Those details coming up next. A Tennessee-based airbag manufacturer has been told to recall 67 million inflators. It's refusing to do it. ARC Automotive has rebuffed the demand from the NHTSA, saying no defect exists and any problems are, quote, isolated manufacturing issues. Yahoo Finance's Pras Subramanian has the details for us. Hey, Pras.
Hey, so yeah, definitely got a lot of details right there, actually, in the intro there. But yeah, so basically, ARC makes an airbag inflator that inflates the airbag in the incident of an accident. What's happening is there's potentially NHTSA as a defect that where when the inflator inflates, it actually ejects a metal particle into the cabin and in some cases killed people, in other cases injured them. So NHTSA says we've had 9 different incidents. We think this is a defect. It's safety recall. We need to do this. ARC says these are isolated incidents. There's no manufacturing defect. We've done testing and found 900 other inflators that we've tested, and they haven't had this defect. So there's a bit of a kind of but it's a bit of a disagreement as to whether this needs to happen. But as of right now, GM has actually recalled 1 million of their cars that have this inflator out of an abundance of caution. ARC says they understand why they did that, but they don't think a full recall is necessary, especially for 67 million units.
I mean, so then if you're one of these people seeing that, this is perhaps a vehicle that's affected by you. I remember when Honda was having the same issue with its inflators as well. What do you do then? What sort of recourse do you actually have? Can you then go to your dealership if you haven't officially had that recall, honored by ARC right now?
I think at this point, you can go to the NHTSA website, put in your VIN ID number for your car and see if there's an actual official recall. Sometimes the manufacturers will do their own. I bet a few will actually follow GM's footsteps here. But as of right now, there's not much recourse you can do if you actually want this replaced, because right now there isn't an official, because the manufacturer actually has to accept the recall and do it. And NHTSA can just say do it, but they can't actually force them to do it. So there's a little bit of a disagreement here as to what will happen next. But I think if enough customers complain to the Kias and the GMs and Fords of the world, maybe you might see more a movement on that.
That's really interesting. Well, there you go. People can still at least enter their VIN numbers in to see if there are any existing recalls and perhaps look for some recalls there. A big thank you for getting us up to speed. Yahoo Finance's Pras Subramanian. All right, coming up, find out the winners and losers from earnings season so far. That's coming up next. Time now for a subdued chart of the day. And that's really the point here. We're most of the way through the first quarter's earnings season, and so far, markets don't seem impressed. 92% of S&P 500 companies have reported results as of Friday. That's according to FactSet. But there have been a fair few beats, of course, but the index remains little changed in the past month. In short, it's stuck, and it's been trapped in the same range for around 6 months now. A little different over on the Nasdaq. It's moving more on upbeat tech earnings. So where is the upside for equity investors in the coming weeks and months? We turn to Steve Sosnick, Interactive Brokers Chief Strategist. Thank you for joining me so far this morning. So a bit of a meh reaction especially from the S&P over this earnings season, staying in that same range. Why do you think we didn't see much movement? And what do you think was already priced in?
Good morning, Rochelle. I think to a certain extent, we got what was priced in, which was not much. We weren't expecting much in the way of positive earnings in terms of big boosts. But, we had the usual assortment of companies beating as published estimates. Remember, the vast majority of companies in any given quarter typically beat their published estimates by a penny or so. I consider that a testament to management's ability to manage the analysts as much as their own business to some extent. But we didn't get much in the way of either positive or negative outlook surprises. And that's often what really drives the big winners and losers around earnings. And there weren't that many true outliers. And to a certain extent, the ones that were a little bit of an outlier, particularly on the downside, got swallowed up a little bit. So the bar was set relatively low. If we're thinking of this, let's say, as a track meet, it was a relatively low bar in the pole vault, and most of the people attempting to jump, got over it.
Just sort of made it over, but no big rounds of applause, as it were. So I want to break down your top winners and losers so far this earnings season. You have 4 picks. You have Chipotle, Meta, Tesla, and Amazon. So break down the base cases as you're starting with your top winners there.
Well, Chipotle blew it out of the water. Chipotle, I think, was emblematic of what we saw in a lot of consumer stocks. There's a wide range of them: McDonald's, Kimberly-Clark, Pepsi. What we found were that companies that were able to raise, many of these companies were able to raise prices and pass along those price increases to consumers who were willing to pay them. That, to me, was a sign that, we know that consumers have jobs. The unemployment rate's 3.4%. And when people have jobs, they want to spend some money on themselves and they want to buy the products they like. And so, Chipotle, they did say that some of their growth came from people trading down a little bit. That may be reflective of some of the economic concerns. But for the most part, it's a relatively expensive fast food item, and people were willing to pay for it, as they were a whole range of others. But that one was the real blowout among a wide range of consumer winners.
And Meta, of course, was an interesting one. You had the huge push from ads, as well as, a lot of people, this talk of this year of efficiency, wanting to see if some of the cuts that Zuckerberg had made would start showing up in some of the bottom lines as well. What did you like in Meta?
Well, I think what I liked about Meta was just, first of all, remember, this stock got deeply oversold into the end of last year. And so a lot of the rally that we saw, in the beginning, I characterized as sort of a delay, the January effect on steroids. But the fact that they've been able to keep the momentum up, the fact that they're saying the right things and apparently doing the right things, and able to give good outlooks, reinforces the idea that this stock has been more than just a fluke year to date. It is also benefiting a lot from the idea of the fact that mega cap tech stocks are really the big beneficiaries throughout this earnings season. Well, throughout this year to date so far. We can argue that might pose a little bit of a risk in terms of narrowing leadership, because a lot of the leaders are these same stocks that are very heavily weighted at the top of SPX, certainly the Nasdaq 100. But Meta did clear a very high bar, and with ease.
And let's talk the losers now from your list. Tesla and Amazon, usually not on people's losers list, but in terms of this earnings season, made your list. Why is that?
Well, Tesla really had some huge momentum going into the numbers. and it just didn't deliver. Now, this to me is emblematic of the earnings season in the sense that Tesla's off its lows now. I mean, we went from sort of 200-ish down to about 150-ish in the aftermath of the earnings. Now we're sort of in the high 160s. And around 170 is sort of where it's been mired. But I think that was emblematic of the fact that, the expectations got out ahead of the stock. It did actually manage to do okay on its earnings, but not enough to satisfy everybody. And I think that was sort of that could have been a real harbinger of a difficult earnings season, because it was the first mega cap to go. It was the first one not to report well. But it wasn't terrible. But I think just, again, it was emblematic of the idea of how fragile some of these stocks can be if expectations get too high.
Speaking of high expectations, we heard a lot about AI and every company sort of throwing everything in the kitchen sink at it. But I want to ask you, obviously we have NVIDIA that still has to report here. So you have it both as a chip maker, but then also this leader in the AI space. What are the expectations there when they report?
I think NVIDIA has a very high bar to clear, because these guys, I give their management a lot of credit, because they managed to put themselves in the forefront of whatever market story is out there. They were, when crypto was the biggest game in town, they were the chip maker that benefited from crypto. Now that AI is the big game in town, they've positioned themselves as the big winner in AI. In their last conference call, I forget the exact number, but they referenced AI, I think, over 50 times in just the prologue. I'd have to double check those numbers. I don't have them in front of me. But they know how to position themselves in the forefront, certainly, of investor mindset. And they've been a huge winner on the AI front. Now, they're one of many, Microsoft, of course, and Google playing catch up a little bit over the last week or so. But, I think the bar is set very high for them. And it'll be very interesting to see to what extent they really throw out the AI terminology when it comes time to talk about the stock.
And another thing we'll be watching, retail earnings this week. We'll hear from Walmart, Target, Home Depot, Alibaba as well is going to be reporting as well. And then when you sort of look at what we're seeing with consumer sentiment, what are the expectations there? Because are we going to start seeing that show up perhaps in some of these earning calls when they sort of add that into this macro conversation about where inflation is still headed in some of these sticky areas?
That will really be the key. I think the conversation will be more important than the numbers themselves, because, quite frankly, I refer to the consumer sentiment numbers as being, they stunk. There was no real way around it. Now, it's an interesting problem, because we just learned, from PepsiCo, et cetera, McDonald's, Chipotle, that consumers were spending more on the brands they liked. But are they able to continue doing that from a retail level? Walmart could benefit if people are trading down, as we saw with Chipotle. Home Depot, how is the housing cycle benefiting people, or not, not benefiting or not benefiting them? And Target is a bit vulnerable, because they may be one of the companies that someone trades down from to get to Home Depot, and I'm sorry, to get to Walmart. And then, of course, we had the inventory issues, particularly with Target. And I think we've managed to sort of put those behind us. I think they've normalized all that, but it'll be interesting to see if any of that stuff persists. There's a lot to learn about the consumer, because the reports, as you mentioned, from Friday, they were quite a downer. Higher inflation expectations and much lower sentiment. Something is not going to add up, and let's see if it's affecting the retailers yet.
So how is that squaring with some of the activity that you're seeing with marginal buyers? Because I know you've written about that. That was a really fascinating part of it.
Yeah, it's interesting to figure out who the marginal buyers are in this market. It's easy to say it's just it's individual investors just in love with their favorite stocks. And to some extent, it can be true. As we noted in the piece, and it's available at ibkrcampus.com or IBKR Traders Insight, as you see behind me. And basically, if you buy 100 shares of Apple and take it up a penny, market cap of that company increases by about $150 million just by one share trading a penny higher. So $150 million, sorry. So it's a strange phenomenon. But for example, today I saw a headline go by that Tiger Management was adding their position in NVIDIA. So it's big investors who are chasing the momentum as well. I think, the risk is that these popular stocks are becoming very, very crowded trades. we have maybe 20 stocks accounting for the bulk of the market leadership this year. If you look at the outperformance, let's say, of NDX over SPX and then SPX over the Russell 2000, it sort of becomes a little evident that the bigger, the more top-heavy of an index, the better you've done. But it's easy to say that it's individuals chasing their favorite stocks, but it's clearly institutions hopping on. They understand what momentum is. They understand where the leadership is. And so right now you're getting a real big flood of money flowing into the biggest stocks. The question is can this A, continue, B, for how long, and C, what happens if someone decides to rush for the exits? But we haven't hit that point yet.
I'll certainly be keeping an eye on that. A big thank you to Steve Sosnick there. Thank you for joining me this morning on Yahoo Finance.
My pleasure.
All right, coming up, you're very welcome. All right, coming up, OpenAI CEO Sam Altman is testifying before Congress for the first time tomorrow. We'll break down what to expect next. The trendiest phrase on Wall Street is getting some attention on Capitol Hill this week. Congress looking to regulate the rapid advancements in artificial intelligence, but for right now, they're still playing catch up. Some events on the docket in Washington this week include first, OpenAI CEO Sam Altman. He'll attend a closed dinner with a bipartisan group tonight. Then tomorrow, the CEO will testify before Congress for the very first time. Joining us to discuss what to expect is Tom Davenport, co-founder of the International Institute for Analytics and the President's Distinguished Professor of Information Technology and Management at Babson College. Thank you for joining me this morning. So first, I want to start off by what your expectations are for the sort of reception that Sam Altman is going to get on the Hill.
Some combination of hostility and ignorance, I would guess. Members of Congress are not known for their technical expertise in general, and yet they want to demonstrate that they are on top of this issue and are controlling big tech. So that will drive the reception.
So, Tom, is it going to be similar as what we saw with the emergence of crypto, where you had, a lot of lawmakers not familiar with the technology and the platforms themselves, sort of trying to ask questions about something that's still emerging, versus this time you have big tech with a much greater understanding here and regulators once again playing catch up?
Yeah, we did see this in the past with social media, and there were a lot of discussions, a lot of testimony by leaders of social media companies. Not much changed, and I would suspect that would be the case with regard to these hearings as well. It's a really complex issue, and Congress doesn't seem to deal terribly well with those complex issues.
Indeed, because you might end up with sort of regulation by enforcement. I mean, a lot of people wondering, should this be on a case-by-case basis? Should it be impact-based, the number of people who perhaps get exposed to it? Or even some of these just focusing on critical industries. What's the approach that you think lawmakers are likely going to take?
Well, your graphic is quite interesting because we should not be addressing this on a state-by-state basis, and we probably shouldn't even be addressing it on a country-by-country basis. What we should do is look at, for example, the AI Act in Europe and say, can we take significant aspects of that legislation and put it into place in the US? Because all of these companies are global and people are moving around the globe, and companies are trying to reach customers all around the globe. It's clearly not a state-by-state issue, and it's really not even a country-by-country issue anymore. It's a global issue, and it should be treated globally.
So then how should people be sort of viewing the potential outcomes of this testimony then, given, as you say, this is a borderless issue, and you have different regions of the world approaching this differently?
My guess is that many of the congressmen and women have bigger fish to fry right now, like honoring our debt commitments, for example. I don't expect to see anything happen anytime soon out of this. It would be foolish to ban generative AI tools because obviously, we want to at least keep pace with other countries around the world, specifically China. And they're doing a lot in this space, a little less than we are, which is, one of the few areas where we're clearly ahead right now. So my guess is that this is more for appearances than for any legislation that might come out of it.
And when you look at the tenets of the EU's Artificial Intelligence Act, I mean, there are certain things that they will likely ban, things like social scoring, facial recognition in public, potentially depending on how it's being used. What do you think at least would have the greatest likelihood of perhaps getting copied and pasted to the US model?
Well, I think both of those things are good. Social scoring, we don't want to have a social credit score like they do in China, where every time you're seen at a demonstration or whatever, your social credit score goes down. I think there will probably be an adoption at some point of legislation related to the use of these tools in hiring, as the New York legislation already has. If you're going to hire someone or reject someone because of an AI recommendation, you have a number of restrictions on how you can do that and how you talk about it with the potential job candidate. So those would be two areas that would be useful. I, for one, would like to see the earliest action taken in the deepfakes and misinformation area. We've already seen former President Trump using this in his campaign over the last few days relative to a deepfake of Anderson Cooper, saying how he showed CNN what they were not capable of in that town hall that he had. I think that would be the best thing that could happen to our country and perhaps to the world. It's a very difficult issue. But that, I think, is the most pressing problem we face right now, at least with generative AI.
And as you mentioned, it's such a vast issue that it can't be just a one company or a one country situation here, especially deepfakes heading into the election season. A big thank you to Tom Davenport, Babson College President's Distinguished Professor of Information Technology and Management. Thank you so much.
Thank you.
All right, coming up, the AI debate heads to Capitol Hill. As we mentioned, the CEO of ChatGPT maker OpenAI will testify before Congress for the first time tomorrow. And we've discussed there the sort of audience we can expect. So be sure to stay with us for more on Yahoo Finance. Let's also take a closer look at our trending ticker as well. We're coming up after the break. Let's take a closer look at the trending ticker now. C3.ai seeing a boost after releasing upbeat preliminary results for its fourth fiscal quarter. The company sees its quarterly performance on track to exceed its previous guidance. The company noting that during the quarter it closed 43 deals as its consumption-based pricing model continues to be well received by customers. C3.ai also highlighting it remains on track with the goal of achieving a non-GAAP profitable business by the end of fiscal 2024. It's been a good ride for shareholders this year. The group's stock has ridden the AI wave, surging over 100% in 2023. Now, choose France. President Emmanuel Macron will extol the virtues of investing in the Fifth Republic today. He welcomes around 200 global leaders, including one Elon Musk, to Versailles. Now, no one quite encapsulates understated Gallic glamour like Yahoo Finance's Julie Hyman, or Julie Hyman. Now, she's also no stranger to the luster of one of Europe's most enchanting nations. But is it just business-friendly, Julie?
Well, I mean, that's what Emmanuel Macron would like to convince the various leaders who are gathering at Versailles. Quite the backdrop for a business meeting. This is the fifth year that he's been holding these Choose France meetings to try to get various business leaders around the globe to invest in France. This one seems to be relatively successful for him thus far. Reportedly, the leaders who are there have committed to invest about $14 billion, about 13 billion euros, and that's the highest amount that he has gotten pledged thus far. As far as Elon Musk goes, and Tesla specifically, Macron tweeted out a photo of the two of them where Musk is wearing a suit, interestingly enough. Macron has his jacket off, however, which I thought was a fun little detail. Already, France kind of lost out because Tesla decided to build one of its gigafactories in Germany versus France, which had also been lobbying to house that factory. But it seems like Macron is still keeping those lines of communication open and talking about future investment of some kind by the likes of a Tesla. It's unclear what that would look like. But there's a lot at stake here for Macron. His popularity is not very high right now. He had been pushing for that increase to the retirement age in France to 64. That had been a very controversial move that had been marked by protests in the streets. So now he's trying to sort of bring the economic picture back, if you will, through this meeting. And of course, Elon Musk, a very high-profile person to attend it.
And an interesting one, especially right ahead of the G7 as well. A big thank you to our very own Julie Hyman. Thanks so much. Well, that will do it for now. I'm Rochelle Akuko, but I'll be back with you at 11 a.m. Eastern tomorrow. I'll see you then.